Ladies and gentlemen, this is your host, Bill Brewster. This one requires a pre-roll because for some reason my mic was super hot when we started recording and I'm a little distorted on the episode. I would have, under normal circumstances, either re-recorded or tried to record part of the episode again, but I got to be completely honest. This episode has meant more to me than any of the others. No disrespect to those that have come before, but Francisco and Alex are two of my dearest friends. They have been through everything with me. They have exposed many of my weaknesses through our discussions. They've enhanced many of my strengths. I appreciate them more than any relationship work-wise that I have. And these two guys are a huge part of why my brain is what it is. I do have to let everybody know that this was recorded in early May, so some of what we talked about with some media assets has obviously changed with the Discovery and AT&T deal with the Warner Media assets, and Alex no longer holds Curate Retail Group, much to my dismay. Importantly, I'd like to add that as I've gotten to know Francisco, what I would say about him is you can give me any media analyst and I'll take him against them. And as I've gotten to know Alex, what I'd say is this guy left a good job to pursue a full-time role writing a Substack. I encourage everyone that can to subscribe to it. He's completely transparent. He lays out all of his thinking. He lays out models. If you are newer to investing and are looking for, the word that comes to mind is a Sherpa. So sorry if Alex doesn't like that word, but that's the word that I'm going with. An investing Sherpa, or, you just want to get a peek into somebody else's way of looking at the world, or if you are in the professional realm and want an analyst for the low price of $350 a year, I think he's a steal. So Subdiz, Substack, I'll put the link in the show notes, and he writes under the Science of Hitting Investing. If you're familiar with Guru Focus, you'll know who he is. So I hope you enjoy the episode. Despite my anxiety recording it, I had a great time. So with that out of the way, I apologize for any distortion, and I hope that you all enjoy a peek into what is my typical conversation with two of my dearest friends. Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster, here with the squad. What do you know about that? My man, the Science of Hitting Investing, also known as Alex Morris. Francisco Oliveira, also known as Franco Oliveira. I don't know why that is. I guess it's a nickname. Anyway, I call him Francisco. Y'all get to hear how we all talk and all of the dirty secrets that these guys know about me and how insane my brain is. Some of them may come out. We'll see. As always, nothing in this is investment advice. Nothing is an invitation or a solicitation to buy or sell a security. Certainly don't listen to anything I have to say, but these two are pretty intelligent, and they're the reason that I am what I am. So, gentlemen, how are we?
How's it going, man?
You tell me. I have this podcast now. You are my executive producer. The chief strategist. What do you think? No, you think I'm putting out too much content lately? A lot of people say they can't keep up.
I think it's the right amount. I think when it's like 3, 4, 5 times a week, then it becomes a little overwhelming. I think once a week is, and your occasional bonus episode's pretty good pace.
Hey Alex, what's the last episode you listened to?
It's been a little while. I was waiting until I came on. I didn't really want to, I want to mess it up by knowing exactly how the format was. So I laid low for a little while. I listened to a lot of the Mike Mitchell episode.
Streets are cold, folks.
No, it's a problem with podcasts generally. You need a way to make it more digestible and easier to discover topics that you want to hear about. And I think that goes for the industry as a whole, and it's going to apply to a podcast like yours as well.
You don't think that people just have like 2 hours to sit around and do nothing but listen to me bullshit with people?
I'm not sure.
Well, what are you doing with your days, Mr. I'm so busy? Why don't you tell people what you're doing?
Well, I'm spending a lot of time trying to write 2 articles a week for this Substack that I launched, and I thought 2 a week would be relatively easy to do, and I'm now learning if I want the quality to be really high, that is essentially a full-time job. So, but it's gone really well so far. I'm enjoying it, and I'm trying to find interesting ideas by talking to the two of you on the rare occasion that you guys have one. And besides that, I'm just updating and trying to not be stupid, which seems to be more difficult than it should be.
Well, it is very difficult not to be stupid. I always knew that 2 a week would be tough for you. Not like tough for you, but like that's a lot of work to put out quality content 2 a week.
Yep.
Especially
how's the experience with Substack going? Go ahead, Francisco.
Oh, no. I was just going to say, especially the type of content it is, investing, and you're trying to kind of keep people engaged, but also provide insight in the type of, I think, portfolios that you guys run and that I run. It's not like we're making huge changes on a monthly basis necessarily. So on a weekly basis could be pretty hard. So no, I applaud you. I think you've started out. I think you both have started new ventures out really over the past couple months, and out of the gate, the quality of the content has been pretty damn good. And I've seen some behind the scenes numbers, and they're pretty damn impressive for both of you.
It's almost like the podcast in a certain sense too, that you're going to have a certain number of people who are really a big fan of you or your work or whatever, and they'll consume a lot or sign up immediately. And beyond that, it's kind of difficult learning the ropes on how you give people a taste on the work that you're putting out. And, balancing the dynamic of having free and paid is definitely a big part of all that. And it's similar on a podcast, trying to get people to listen to 20 minutes is really hard to do, but if you can get them to listen to 20, they might become a full-time fan. So it's figuring out how to make that work too. So there's a lot of marketing and, branding type stuff that plays into it as much as the analysis or whatever else.
Alex, how far have you planned out some of your write-ups, or is it kind of spontaneous?
So in terms of the quarterly stuff, I have a decent idea of the calendar and the companies that I'll almost certainly cover, like Comcast, Facebook, things like that. I have a handful of companies that I've done analysis on that I've kind of stockpiled, that I'm either waiting for the right time to pitch them because I think they're interesting, or I'm just saving in case I need them if I get stuck in a spot where I need to use something quick. So I don't have a ton of stuff that's stockpiled, but I definitely have some in case I need it.
Nice.
I have found that I don't know, man, producing content is much harder than I thought it would be. Having the actual conversations is pretty easy, but then like getting the editing right. Shout out to Matthew Passy. He's been doing a great job lately. But in the beginning, that was a lot of work.
Yeah, I bet. I mean, how was it for Francisco? How was it for you when you obviously you went on Andrew's pod to talk about Roblox and you put out that kind of public pitch, which you've done that a couple times before with Disney and a few other things, but this was more kind of your own doing. What was your kind of experience with that?
Well, it made me realize what you both do is extremely. You got to dedicate a lot of brain power to it, and I think the Roblox kind of idea and kind of summary write up of my thoughts and why I like the business. It took considerable time to not really, because you read a lot, you think a lot, you talk a lot with different people, you sort of have this idea of what you think about the company, but when you put it in paper, you write, and then it's kind of like, well, that's not what I really think. It's actually better than this, or it's difficult to kind of collect your thoughts and make it in an easy, digestible manner. I think that's why a lot of people say that when you write, it allows you to clear your head and think a little bit simpler and clearer of what you're really studying. So I mean, it's a lot of work and it's hard. So writing twice a week and producing a podcast once a week or twice a week that you both do together. I mean, well, separately in your ventures, I think it's really tough. So the Roblox kind of analysis, and it took a lot. After I finished, I was like, wow, that was a big, kind of like running a marathon, but I didn't feel like I was rushing or anything like that. I was just I really did it for clients. I used to write a quarterly letter to clients, And then I thought it was, when you're writing quarterly letters and you have a concentrated portfolio, you're not really making a lot of changes on a monthly basis. Then it became, quarterly letters begin to get a little bit more about like, well, what's happening in markets that's really not important to each portfolio company, or what's newsy information happening about each investment. And it took away, I think, about thinking long term about companies. So I changed it to a letter that's twice a year, and it's a little bit more thoughtful about each investment. But then I realized, well, you're only communicating in a longer form way to your clients twice a year. That's just not a lot. So decided that in between those letters, if there's something new material in the portfolio, that would write basically an analysis of the company. And that's where the Roblox kind of piece comes together. And then I decided to share it, thanks to you guys, talking to you guys, whether I should share it publicly or not. It's a large company. Many people have covered it. So for some people, it's not like, game-changing information. But I thought it would be helpful to connect with different people who maybe looked at a company from a different perspective. And I thought that was helpful. So I thank you both for that.
It's not that. I mean, a lot of people have covered it, man, but it's still really early in that company's public life.
Oh, yeah, definitely.
Like, why don't you talk a little bit about your research? I think, like, Buffett always talks about Charlie being his abominable no man, and that's what I think of with you. And I think I have, like, crazy thoughts where I'm like, dude, what do you think of this idea? And you're just like, what are you talking about? And that helps me. Sometimes I stray from your guidance, and then I end up regretting it most of the time. But, like, why don't you just give people a sense of what, like, your research process is?
Well, it's not that I'm dismissive of ideas you might share. It's just the way I think about it, really, if I want to have a more business mindset to investing in a long-term approach and a concentrated portfolio, then it really has to be something that you really want to dive into. You really want to be extremely knowledgeable about the business, management team, industry, and then be able to write out ways whether, a company can report earnings. Like Spotify the other day, stock goes down, 15% in a week or something. So you want to be in a situation where you're not the one who's kind of like being blindsided by that, or it would have a knowledgeable reaction. So when I'm looking at something, if it's an industry, I just know it's going to be, the amount of brain damage and going through it and understanding it might take months, and probably not the type of thing I would commit 5 to 10% of the portfolio in. Then it's an automatic pass. And maybe I can be learning little by little about it, and over time I could get there. But classic industry, just like healthcare, it's like automatic no in many aspects. And there are things that are this is not a perfect approach, and it'll cause me to miss a lot of things, but it'll also keep me focused on my strengths, I think, as an investor. So I mean, there's nothing really unique about my research process. It also has to do something that you gain a lot of interest in. And so one has to be careful that you can gain a huge interest in something that's not necessarily a good investment as well. But I think interest and curiosity keep you motivated throughout the research process, because if you're just reading about a company for months, right, it can't be like reading some very dense textbook and you're, kind of powering through that, right? I don't know, I think you got to be curious and interested in the companies that you're looking at. So I think those are the main drivers that keep me focused and pushing and studying and analyzing companies.
As you find yourself, and for both of you, as you find yourself shifting more your attention to companies like Twitter, Spotify, Roblox, where, in terms of the quarterly or annual results, it's so much different than something like a charter that you both like, where you have a general sense for the numbers are going to come in a pretty tight range, and if they're outside of that range, you either need to be able to explain it or not. And with some of these other names, you're kind of moving into a different world. Do you think your approach to position sizing and how you react to quarterly results and things like that has needed to change as a result of that? Do you think it is basically the same approach, or is it kind of a different type of investing?
You want to go ahead, Bill? Or?
Yeah, dude. My 2 cents is, I am not comfortable sizing something like Twitter like I sized Curate, for instance, right? Now, the reason is a couplefold. One, with one of them, I was getting a lot of cash back. So, like, it was naturally sort of desizing. Two, like, that equity was too cheap. You know, Twitter, I think that there's a reasonable case to be made that satisfactory returns can occur. But, I mean, I understand why there's doubters. And I think that, like, if you don't understand why there's doubters, then you sort of haven't done any research on it. And then I think that the doubters will be proven wrong, but I also think that they have a fair amount of history on their side. And, you know, I think Francisco's comments on, you know, let's see how they do getting the credit card data is like very real. So to me, I'm not going to size that in a way that it can like really hurt me in a real way. Now, some of me says like, okay, well, why do I even own it? And I guess that the answer is like fundamentally, I do kind of believe in diversification a little bit as somebody that's 100% pretty much allocated to stocks. So that's like, I think a couple people would argue that that's not diversified at all. But within that bucket, I think that it's like, look, I don't think Twitter is going to be correlated with Curate, right? And I don't think it's going to be correlated with like SIBO, for instance, which is something else I own. So like that, I do think it's actually a non-correlated equity bet. And I will acknowledge to those that are more asset diversification focused that I'm not very diversified from an asset perspective. Shout out to my man, Jason Buck. I know you're trying to get me to change that.
I think definitely, like Bill said, there's some businesses. Well, it's all about really the downside, right? You don't want to size something at 15% that has a real chance of, you know, a business going out of basically being irrelevant in 5 years, especially if you're long term. So I think the way I think about it, yeah, there's a business like Spotify. There's more variability, at least in what's anticipated in the results versus a charter. So at this point, definitely. But also, what's the real downside of Spotify, right? Is there a real chance that it's a business that's worth half its value? I don't know. I would say that's a low probability, right? But also achieving that upside, that real upside, right, is not something that has a huge execution versus maybe a charter whose real upside, there's not like an exponential upside scenario. And it will probably be easier to achieve kind of a satisfactory type of return. But look, I mean, once upon a time, Charter had no free cash flow. And, you know.
Oh, it's a pass. Pass.
and
screens terribly.
It's cheap on current numbers, Francisco. You can't look at it.
Exactly. I mean, I think before they...
Oh, wait, expensive. Sorry, my bad. I messed that up. Damn it.
Before they acquired Time Warner Cable, right, the CapEx as a percentage of revenue was like mid-20s or low 20s, and free cash flow is non-existent. And the investment was in the belief that this CEO was Tom Rutledge was special and was running a really, really great asset in a great industry and was going to be able to get a lot of cash flow out of the business over time. And you got a big cherry on top if they were able to do aggressive M&A. So I think as the further you look, the variability is high, and downside is, you know, the perception of downsides to the eye of the beholder. But of course, right now it's Charter, which I do own, is potentially lower downside risk reward than Spotify. But I wouldn't also size Spotify as a small investment from personally. Twitter, I don't own. We've talked about a lot.
I know you don't need to come at Twitter. Come on now.
I'm not coming at Twitter.
I'm just joking. So, all right, dude, to give people a sense of when you say you own Charter, do you want to like give people a general idea of what owning Charter means for you?
Well, it's a pretty... I've owned it for over 6 years, close to 7, I think. And it's a position that is about a quarter of the fund that I run. So nicely over 20%. It's a big position. It's composed of Liberty Broadband and Charter. I've owned it for a long time, so it wasn't initiated at that size, right? So it's also a different equation when I got in. But yeah, it's a company that I like, and I think they're doing fairly well. It's a fantastic asset, and I think has a cash flow stream that is super defensible for many years to come, and that should improve.
Did you get nervous at all when Buffett was talking about his Verizon investment, saying that he had no unique insight into why he bought it?
Well,
which he did not say Verizon, but I think that's kind of what he was talking about.
Yeah, I mean, he was flat out asked about Verizon, and I think Buffett sometimes gives more insight if you sort of ask about a company without asking why you buy it, why he bought it. So if he's asked, hey, why'd you buy, I don't know, Kraft Heinz? Well, I guess now he's on it for many years, but something relatively soon, he'll give you like, oh, we don't really talk about that. Is the answer here he was given. But I think if he were asked something about how, what are his thoughts about the telecom industry, wireless industry, I think maybe he could have given a better answer. But yeah, I think I was surprised to see that he bought Verizon. It's obviously not a huge investment for him by any means, but some of the Todd or Ted have exposure to cable companies, so they know the industry well. I think they've owned AT&T in the past and even Dish. So they understand, not anymore, but many years ago. So I imagine the three of them had conversations about the industry. So I'm surprised he bought Verizon, but I hope the investment works out. It doesn't look
not
expensive.
Too well though. Not at like Charter's expense.
Well, I mean, I like the Verizon CEO said the other day, cable companies taking market share and wireless is equal to Verizon taking market share in wireless. So to the extent that they see that as success, then hey, Buffett and Charter shareholders can win.
There you go. Well, we'll see. I don't know. I thought that was an interesting meeting. I like the format when people aren't getting up and having their 8-year-old ask the questions and saying, I fed my 8-year-old a DCF and she has this question for you.
Yeah, I agree. Definitely.
But I don't know. I guess I had tweeted out early in the meeting that I really liked how it was starting, but I guess towards the end, I don't know. I like that meeting. Whatever. I'll just.
What'd you like and dislike about the meeting, or any answers in particular that come to mind?
I'll tell you what, man. Charlie was sharp.
Agreed. Big time.
And like he had the knives out, and he wasn't afraid to say what he thought. And I think he missed that stage last year. So I don't know. I guess that was my major takeaway. I did find the comment when Ajit Jain said that he wouldn't underwrite an insurance policy that Elon was on the other side of. I was unsure of what he meant by that comment.
Spicy.
Yeah, it's either incredibly nice or incredibly rude, and I'm not sure what it is, right? Like, on one hand, you could interpret it like he's so smart, I wouldn't want to out, probability him. And on the other, you might think he's a bit of a shyster. I'll tell you one answer that I really liked when they were talking about Texas and Berkshire Hathaway Energy, and Buffett was like, look, we're going to deliver on our bid, and if we don't deliver, we're going to pay Texas $4 billion, and I don't really care what we lose to if we lose, but if we lose, that person should be on the hook. That's pretty fucking dope. That's the stuff I respect about that guy.
Yeah, it's an amazing asset. Amazing business they've built over time in that entity.
Well, the way he said it, right? The way he's talking about insurance contracts, where he's like, if you sign a pandemic contract with us, we're not going to have some random clause that you didn't know existed that we're going to back out of our insurance, right? I don't know. He reminds me, people used to say Arnold Palmer did deals on a handshake. That generation, the way they did business, I'm sure I have him a little bit heroized in my own mind, but he's a cool dude.
A part something I found pretty interesting. Obviously, a lot of the questions early on in the meeting were about the pandemic and not really doing anything in March. And I thought, it's the same thing always with Buffett. He doesn't care about macro, but then when he starts talking about that, everything's about macro because it was incredibly relevant at the time. And he talked about the idea that the day before March 23rd or whatever the day was, a week before, he doesn't even think Berkshire would have been able to issue bonds. Like that's how quickly liquidity was drying up. And he talks about how obviously fiscal monetary policy was aggressive. He didn't know how it would go, but I went back and looked just to see what that period was really like. And I was surprised to see that on February 10th, the market, S&P 500 was at 3380. On the 16th of March, it was at 2305. How long do you think it took to get back to where the S&P had started the year from that bottom? If you guys had to guess.
Like July?
I think it was quicker than that, man. It V'd hard. Maybe Mayish.
It was right in between. It was like basically June 1st was when it was pretty close to where it had started the year. So from when he thought, or when anybody objectively with the facts now would say, yeah, that was a really ugly period of time, to when the market was back to where it had started the year was basically a 2-month window. And it's kind of, now the market's 30% higher than where it was at the end of 19. So when you frame it in that way, it's kind of like, well, yeah, someone's sitting there with 100 billion plus not being able to put a lot of money to work. It makes a bit of sense. You compare it to like the financial crisis, the market took like 5 or 6 years or something to get back to where it was pre-GFC. And obviously they're not identical situations, but you can understand how they would have a bit of an issue putting a ton of capital to work quickly. My one knock, on the other hand, would be when he frames their cash balance relative to, what was he saying, as a percentage of their total assets, basically?
Yeah, he said like 15% or so.
Yeah, he's getting a little squirmy with that answer there. I didn't totally love that idea. You framed it slightly differently in terms of how you might act if you had the opportunity to do so. So I don't know. That answer to me was really interesting. I don't really know if it changed my perception at all of what they could have or should have done, but it was a good reminder that just how quickly things got crazy and then rebounded. And obviously plenty of people were saying markets were expensive going into the year. So it's not like it was some fantastic deal when it got back to where it was and you knew the government was going to act.
Well, here's the thing. There's two things that kind of jump out at me. One is that you said June, right? But if we rewind last year to May, his annual meeting, it felt to me like he was fairly nervous about the situation economically.
Mm-hmm. Yeah, I agree with that.
And we were not, it didn't feel like we were out of the woods. So you look at that, right? And he wasn't going to necessarily start shooting bullets if he doesn't really have an insight. And the other thing that he kind of said in this year's meeting is the question on why he sold the banks. And it was like more of a macro reason.
Yeah.
He gave more of like, well, the business is great. It's better than before. It's a great business. He kind of like wobbled, but then he said, well, I didn't think it was going to be as good economically, basically. And it's been better. He's admitted to that. So it was more of a macro reason why he sold the banks. I think when he kind of gives you some insight when he talks about industries and mix it with companies, which is why I think he would have said more about Verizon, because when he was asked about the railroads and competition, I thought that was interesting because then it kind of shows you, well, Kansas City has this, contract in Mexico, but it's only until 2040 something, I think he said. So I don't remember the exact time or but only a long time, but not forever, right? So he's kind of showing why it's not super valuable, I guess. And then he said basically that they had looked at buying CP. I had never heard that before. Maybe I had missed it in the past, but
I think he said that. I didn't think he said that in like a news-making way. I thought he just kind of said that like we all look at each other's assets, so we all have a sense. I'll tell you what, man, he didn't say that he thought that deal was cheap. He was basically like, yeah, everybody's playing with other people's money.
Well, I mean, I think he said that financing it is so cheap, and obviously there's synergies that you could probably make the numbers work, but not. I don't know.
Well, I think what he said was something along the lines of no one's actually going to care if the CEO made a return, but when he retires, people will remember whether or not he made the company bigger.
Yeah.
Because I was like, whoa.
What was his comment along the lines of like, yeah, we bought a basket of equities that we don't really know if we actually know anything about them, but we just decided to do it because it's better than treasuries? I mean, was that the gist of one of the answers? Does that ring a bell?
That's what I thought. I thought he was talking a little bit about Verizon and probably the Japanese basket, because he said they didn't have like a unique insight into that.
You think he's just going to fold on holding all the cash?
I mean, dude, the thing is, he just doesn't have the chance to buy things as the lender of last resort anymore. And like, I don't see how you can operate on the assumption. I mean, I guess you can say, well, there's some scenario in the world where Berkshire is the lender of last resort, but I think after this policy response, it's very, very hard to bet on that.
I just think he kind of teased the minimum cash, because he said they could basically buy something worth $80 billion. So what they have, $140 billion in cash, more or less. So you kind of get a sense, or maybe a little bit more than that. So you kind of get the sense that maybe he wants to keep 60, 70 million around. And my guess is, it's just, imagine Berkshire buying a business worth $100 billion. It's not a ginormous group, especially when you take out, banks and companies that he really can't consolidate, and take out some industries that Buffett's never going to buy, or at least $100 billion worth. And it's difficult. It just seems like lender of last resort happens like in these really, really crazy periods, and that's once a decade or once every 20 years, and who knows when that happens again. Probably will happen at some point, but who knows how fast it'll come. And then just buying a huge, huge business, I just feel like that opportunity is going to be very difficult for him to execute on anytime soon. So I think it's all about the buybacks.
Well, it's also interesting too. I mean, even on Apple, the sense I got from their answer was that Buffett wanted to trim, I mean, not a significant amount, $5 billion or whatever it was, and Munger was kind of opposed to, or wouldn't have done it if he was the one making the decision. And it gets this whole idea of opportunity cost. And are you selling Apple because you don't think it's going to hit some hurdle rate of whatever, 8, 10, 12% a year? Or are you continuing to hold it because it's better than the alternative of adding another 5 or 10 billion to a cash pile that you have no idea what to do with anyways and can't make any money on? It's always one of those hard things to think about. If you're going to hold cash, and this is more applicable to what we would be doing in our personal portfolios or something like that, but it's just always a hard decision, because I think it mucks up how you think about the whole idea of opportunity cost, or it can.
Well, I mean, if you're running a portfolio and it's concentrated, but then you just get a lot of inflow of cash, it makes it easier to keep things, honestly. That especially, if they run up, because eventually everything's getting diluted anyways, and you're going to have so much cash that you can buy things that are bigger. So I think it's a different decision versus kind of running a portfolio that's not getting necessarily cash flow. And if you buy something, you got to sell something, most likely. So it's a little bit more complex, like you said. I think probably it's better to keep Apple than just pile up the cash, unless it's going straight to buybacks.
You know what he says that like drives me insane is when he's like, Apple just used their cash to buy back stock. So Berkshire shareholders like got more Apple and it didn't cost them a dime. And it's like, all right, bro, but like that's not exactly how it works. And I know that you're smart enough to know this. He's good at
framing stuff. He's good at framing stuff sometimes when it's really nice and convenient to do so, especially when it's a company that's not Berkshire, so he can just give them a nice little pat on the back regardless of what they do. But yeah, that thing drives me crazy.
Back. Let me push back. Why does it drive me crazy?
Because it's a lie. Because it's not true.
Why is it a lie? Why is it a lie?
Because that cash has value.
I mean, dude, here's the thing. If you are Apple buying in shares, I mean, this happened with Coke. It already happened. Now, maybe Apple is different, and I understand that it might be, but like with Coke, he was just kind of like, well, we keep owning more and we're okay with that. It's like, all right. I mean, I get that, but also there is a limit to when they should be buying back shares, right? If $40 billion or whatever retires 1% of your company, which I understand is not exactly the math, but not all that far off. Like, I don't know. There's not a better use of that cash somehow. I'm not sure that that's true.
I have a a different view. Not a different view. I think we're going to agree on this, but I think Coke is a little bit different. It's a situation that it got dramatically overvalued, right? And the business was getting worse.
Yeah, that's fair.
I think when it's buybacks, it's not just, oh, it's a stock cheap or it's a stock expensive. Because you can argue, because then what makes it cheap or expensive, right? It's the future value of that business. So it's stock with a high, you could look at it like, 52-week mega high multiple, but might be super cheap in buying back stock. So I think, in my mind, look, if the company just has excess capital, like excess capital for real that it does not need, and the stock is not, it might not be like super cheap, but it's kind of in the range of intrinsic value, and the business is not really going to have trouble going down the road, because you want to be buying back stock in a business that's going, where it's contracting, then it's probably good to buy back stock, right? If the business is kind of contracting and going down, just dividend, special dividend. But, I think a Coke situation, very, very, very high multiple, and the business performance over the next decade plus is not going to be attractive. That's obviously don't buy it back. But looking back, probably Buffett didn't think that was going to happen to them in terms of the business performance. And he thought, well, like, if they buy back here, it's not going to be the end of the world, because then the stock will revert and they'll keep buying back, and then kind of a wash in a sense. So it's I don't know. It's there's not an easy answer when he says, like, well, for Buffett, it's different in terms of being price sensitive, because he's got other things to allocate capital. But a singular business, I don't know, look at Charter. They bought back, a third of the company over the past couple of years. If they had just piled up cash in certain moments that the stock looked a little bit too expensive, and then bought back a lot when the multiple was a little lower, that's also extremely hard to execute as a company, right? And it's not perfect. And what if you were slightly wrong, you waited, and then you missed a big opportunity to take down a chunk of your shares? It's probably better just to keep a consistent buyback program. If the valuation is not wild and the business is going to do fairly okay. But I don't know.
That brings it back to the start of this whole discussion that we're having on this, which is I think that's partly what he was saying when he was like, yeah, I don't really know if I have a unique insight on these groups of businesses that we're buying. He was almost like saying it doesn't make sense to hold this much cash anymore. And honestly, I think back to, there's this idea that they invested super aggressively during the financial crisis. And I think if you look at how much money they actually spent, it's something where they didn't stockpile cash for a decade to make those investments happen. Maybe I could be wrong on that, but I looked at the number. I mean, they spent 15 or 20 billion or something, which surely isn't nothing. But I just don't know if there's true incremental value add from trying. It'd be like doing in your personal portfolio, stockpiling cash for years and years and years, waiting for a chance to buy stuff really cheap. I think what we've probably all learned from investing personally is, granted, we're saying this after a very long bull market, but that's a very difficult way to play this game. And I'm wondering if what you just said about companies in general probably should have applied to them for, much of the last 10, 20 years.
I think that in general, I have benefited. Well, I know that I benefited from having cash. But on a go-forward basis, I don't think that was the right thing. Like, I think I just got kind of bailed out, which sounds horrible to say, by a pandemic. But between, like, the pandemic and December of 2018, having cash, like, objectively did help my results. But I don't know that I really want to bet that going forward. On the other hand, like, I don't know. I could, there, like, Corey Hoffstein and I were having a discussion, and he was saying that, like, an interesting comment that he had was that, like, the typical mutual fund used to carry like 5% cash. The typical ETF carries like 0.5%. So as people have rebalanced towards ETFs, there's like a natural buying in the market, and also less cash, right? So like this idea that there are more tails, both sort of good and bad, is one that I think that he would say that, like, it's at least plausible. I think what he said, and I'm trying not to misquote him, listen to the podcast if you're curious. It's towards the end, but was that like he's doing research on whether or not it makes sense to just carry puts as sort of insurance rather than like a typical 60-40 portfolio, because he thinks like, let's just say you think that stocks are going to return 5%. So 60% of 5% is 3%, and bonds are 0 right now. So let's call it like, 3 is like what you own, and you get some diversification. Does it make as much sense to just go like 98% equities and just burn 2% on puts every year? And I think what he's shown is that the return profile is actually quite similar. This is all just a long way of saying that I don't know how I'm going to run my portfolio going forward, and this is really hard because I do think that like I have objectively been pushed into thinking about these longer tail ideas, and what by tail I mean duration. It's hard to argue that that's not a function of rates and where just sort of the world is right now.
I think.
But I don't know what you do about that, right? Like, I can't sit around and wait for the world that I wish existed. Like, you got to navigate the world that you're in.
No, I agree. But if you look at that puts idea, I think it's interesting, but also have it play out, right? Let's say they expire every 2 years, probably worthless. It's 2% of your portfolio. So you're burning like 1% a year. 5 years can pass by. You burn 5% of your portfolio, but they come in handy if you get a March 2020 and that position goes up like 10x or something. It's hard to execute on that.
Yeah.
Because you're going to have to rolling them. They're going to be expiring. You're going to stay in there, and you're like, it could definitely work out. I don't know. I go back and forth on that issue, and I think sometimes it could be prudent to have a 10, maybe 15% cash. I think when you're going to 30, 40.
Yeah, that's great. Yeah, that's too much.
It's not.
No, I've said it before, like half jokingly, if you're going to do that, if you're going to go 10, 20, 30% cash, you need to take like 1, 2, 3% and put it on some YOLO, the exact opposite of what if you're thinking the markets are crazy,
yeah, dude,
you need to find something that you think is already the craziest and put some of your money on that.
And just fucking buy like out of the money call options in
Yeah.
case you're wrong. Yeah, that's not a bad idea. It's
And
kind
this
of
is-
the reverse hedge.
And I'm thinking about this as just a fun stock picking fund. All type of structures are different. Personal portfolio, big asset manager, kind of an endowment, and all this stuff. I'm thinking about more like you're just stock picking, right? If you're going to 30% cash, that is a market bet, in my opinion, right?
Yeah, I agree with that.
So you really.
So is Berkshire going to 140 a market bet?
I don't know, because look, they have leverage as well, right? So it's more, if you net out some of the debt the subsidiaries have, and I think the holdco has some debt, and the float is liability. It's not like it's a gross. It's not like a net cash position that is enormous, right?
Mm-hmm.
Well, it's big. It is big, but it's not like 30, 40 the things that we're talking about.
It's smaller than the headline number too, right? Like people don't understand that a lot of the times.
He wants this company to become $1 trillion company in his lifetime, right? And this is not decades things, and 140 billion in cash for $1 trillion company a couple years down the road is not insane. So
you think he wants that for real?
Yeah, for sure he wants to be $1 trillion company.
You think?
I think he gave up on that with the repurchases. He's going for $1 million a share on the A shares. That's the new
that
goal.
Would be kind of dope.
That'd be nice.
Yeah, that would be.
Well,
not for me because I don't own any, but
yeah, but the B shares, they got that arb.
That's
you could
true.
say it. You could say it both ways, that the repurchase is accelerating intrinsic value per share, so it's going to could get the market cap closer to intrinsic value. So I don't know. I'm not sure whether it's a bet. Also, it's kind of what we talked about. Cash is coming in. Cash is coming in. Cash is coming in. So he's got to, in theory, deploy all that cash and then reduce the cash balance. And sometimes cash comes in that's not necessarily free cash flow. It can be a huge insurance deal. So it's a bet in some ways, but it's also like the amount of cash coming in overwhelms what he can put to work naturally. And I think he's realized slowly that he just can't put it all to work, and I think that's the reason why you're really getting buybacks over the past kind of year or two versus
I think
many years
he
of
was
talking about it.
I think he was waiting for March, and then March came, and I mean, I think policy just kneecapped him, and I think then he realized I can't be the lender of last resort, and if I can't be the lender of last resort, then I might as well buy in shares. I think it's actually like very rational, the evolution, but I think that he was kind of also what I'm about to say is kind of sick. I don't think Buffett was actually like hoping for March, but I do think that a lot of his shareholders were, and like I kind of was too, and not in a pandemic sense, but like a little bit of a crash where he was there. And something that I've had to like kind of look at myself in the mirror is, you know, do I really forget about what I think is right to do, but like, do I want to wait for crashes to be a liquidity provider? And like, is that actually a healthy thing to put out into the world? I don't know how much I believe in karma, but like I don't think that waiting for everyone else to be in massive pain so that you can make a huge bet is necessarily the best way to live life.
Well, it's kind of funny you frame it that way, because I think Seth Klarman was interviewed a couple years ago by Charlie Rose, and he was basically asked that question. Like, do you desire kind of market malfunction and stress? And because obviously that implies something that's happening in the real world that's not pleasant for people. But in that happening, right, it creates opportunity.
Yeah.
So before, I used to think that was probably a smart thing to do. Now I think like you just have to be aware of things, and it's going to be really hard to predict these things. But focus more on the businesses, right? And if you have a concentrated portfolio, you're thinking about these businesses all the time and the new businesses. And yeah, maybe I won't be able to call like the next subprime meltdown, but you know, talking to a lot of people that maybe will be able to point me in the right direction, and then being smart about the businesses that I own will kind of help me out with those investments and future investments. So I don't know. It's to focus. You know, after the financial crisis, a lot of people dedicated a lot of time to like the next event, inflation, or another crash. And I think it consumed a lot of people into thinking that we just had this crazy once in 100-year event. It was something similar was going to happen like relatively soon. And I don't know, thinking like that consistently about things that are as if they were going to happen super soon, I think can divert you away from more important stuff. Like, look what's happened with the FANGs, right? The major tech giants. That's just kind of
those were crazy results. Crazy.
They just kept swimming and swimming, and people can be worried about inflation, this or that, and these companies just little by little, bam. You know, I remember when Apple became $1 trillion company, like super huge news, and we have a bunch of them, right? And Apple's like,
I sold there, thank you. Super smart.
I sold around there as well, a little bit before, unfortunately. But yeah, so it's you know, that's also kind of a huge event type of thing.
Dude, you know what their TTM free cash flow is? According to like a screen. I haven't done that. I don't know how many adjustments are needed, but $90 billion.
Wait, which one? Apple or
Apple?
Yeah, I thought you were saying all the FANGs together.
No.
But yeah. Yeah.
That's nuts. So that thing's trading at like 25 times trailing free cash flow. That's not that nuts. Like, that's why when people are like, oh, the stocks are so expensive, it's a 4% free cash flow yield on a really fucking good asset that owns basically a tax on all internet businesses. Now, a lot of that may come under pressure. I don't disagree that there's iPhone potential obsolescence. Like, there's a lot of stuff that you can talk yourself into. Fact of the matter is, for a long time, I didn't think this thing would have the runway that it has, and it just keeps chugging. Well,
to your point, the focus was on iPhone, you know, being a product that's just going to be a fad. Even like in 2014, 15, they were talking about that. And sorry, Alex.
No, I was just going to say Buffett's comment about the iPhone, which he said this in different ways before in the past, but his comment at the meeting saying, yeah, there's a lot of people who you give them the choice between their $30,000 car and their $1,000 iPhone, they'd take the second one. And amongst the people I know, that's got to be like 95% plus who would take the phone over the car. I mean, it's not even close. It's insane how much that innovation from '07 has just completely changed the entire world.
I'll tell you who I watched kill that call was Sarab. Fuck, I always mess up his name. I'm sorry, man. I don't mean to.
You're talking about the Apple call?
Yeah, man. I watch it. I mean, he and I talked about it a little bit. Not that we talk like all the time, but we were in a group together, and he wasn't like, he wasn't struggling with it by any sense, but like he was kind of like, man, this market cap is kind of mind bending, but look at the math behind it, and it makes sense. And he was totally right. I got a little bit psychologically tripped out by $1 trillion, like straight up.
Well, the focus was on unit sales, and remember when they decided not to report actually iPhone units anymore, and people were like thinking like, well, this is the end of Apple. They're just reducing disclosures, and now basically they're trying to frame the services revenue, and it's growing, but it's not a big deal. And now it's like, to your point earlier, services is a tax on the mobile internet, and they basically own 30% of it.
It's crazy.
Still not that big of a percentage of revenues, though, which is even more mind-boggling.
Yeah, but it's I don't know. It's crazy.
Big margin.
Oh, huge.
It's crazy to think that, going back to our discussion before about kind of balance sheets, capital allocation, that sort of thing. Imagine. I mean, obviously the stock's done insanely well, but imagine if Jobs had listened to Warren Buffett when he asked him what to do with all the cash they had. If they had started this net cash neutral balance sheet positioning 10 years ago, oh my gosh, it's unbelievable to think how low the share count would be right now. People, they've done okay anyway, so they'll be all right, but that would have been insane. I mean, now they can't even spend it quick enough. When you're printing 90 billion, it's hard to spend that much.
I mean, dude, you asked me like, investing in Twitter, and I told you guys I bought a small amount of Spotify just because I want to make money with you guys.
Congrats.
No, but like I think how I've really changed as an investor, and I might be wrong on, Twitter, whatever. But like, I care much more about the asset that I'm buying than I ever used to. I used to think a lot more in like valuation terms, and I still I'm like, I get it. If I pay $50 billion for an asset and it doesn't work out, or like it doesn't generate cash, I'm going to get screwed. I fully understand that. On the other hand, a lot of the guys that I think have got records that I really admire are guys that have been able to think 5 to 10 years out and be like, what can this asset actually potentially do? And they've been wrong at times, but when they're wrong, it hasn't killed them. And like Buffett was saying, they've been wrong before, but when they're right, they let it run. And I think if you get like, I don't know, for me, I'm going to try to continue to try to build wealth for my family by buying unique assets. I think like that's the goal for me, and then to pay a fair price for them. I'm not really into, I don't know. I mean, obviously I'll go into curate, right, with the right situation, but I'm not trying to buy like mining companies at 0.25 book to play some re-rating. Like those days are long gone.
What do value investors, traditional, you read Buffett, you read Graham, like value investing books, when you get into investing, there's two things you learn: price and long term, right?
Yeah.
There's many other things, markets, you're basically benefiting from the market. It's not your friend or foe. Your Mr. Market gives you a price every day. You basically, when it's crazy cheap, you pile in there, right? But in my mind, a lot of people like going after cheap that is not a quality business, to your point. Being a long-term investor is actually a negative, right? Because if the business quality is not there, time is your enemy, not your friend. And you want to invest in things that time is your friend and not your enemy. So I think that's why, and I agree with you, Bill, looking for businesses that are strong and getting stronger. This is what Buffett says, man. Like, I want companies that are getting strong and getting stronger. And that's what allows him to be also long-term, among other reasons. But you can't be long-term if you're buying an asset that is just cheap, but it's not the best asset, right? You basically need a catalyst for that cheapness to be realized quickly.
Yeah.
The other part
that's
is the right people too. I mean, it's as part
100%.
as part of my learnings, I think happened to a lot of probably Buffett accolades is I took the wrong message from the invest in a business any idiot could run because soon one will, or the comment about the jockey versus the horse. And I think at this meeting, Buffett said something along the lines of, the disclosure that you never see in filings, but that should be there, is that the real risk is getting the wrong manager in there.
Yeah, I thought that was interesting.
I think about Value After Hours, Ian said he looks to invest in micro caps where they have a manager now or a founder, whatever it would be, who had an exit for 200, 300, 400 million, and now is doing the thing that they really wanted to do all along. And they have the proven ability, and they have the vision, and they have, the passion for doing this. You literally can't overstate, at least I can't, when I look at my portfolio, to know that Satya Nadella is running a company. When I used to own Schwab, to know Walt Bettinger's running a company. Like Daniel Ek. These people, I don't need to watch anything they do. Basically, I mean, it's the equivalent of investing in Berkshire in a lot of ways. I trust the people. That's one part I've always found interesting with people who invested in Comcast, and not that it can't still make sense as an investment, but if you think they suck at capital allocation, you don't really think Brian Roberts is smart, at some point it's like, why would you want to partner with him? I think that idea really should be, especially if you're concentrated, it's why are you going to part with people that you don't trust or you don't think are smart and that are going to make smart decisions for the next 2, 5, 10, 20 years? It seems insane once you really start thinking about investing in terms of owning part of a business.
To be clear, you're long Comcast, right?
Yeah, but I think I've always felt differently about Brian Roberts than other people have, and I think time is proving that they might be right and I'm wrong. So,
no, I don't know about that, man. I don't know.
No.
My concern for Mr. Roberts as some nobody that knows nothing and going up against a guy who's a CEO that has transitioned a company through tons of difficult times and made a great acquisition in the heart of the financial crisis. So this means nothing, what I'm about to say. I am a little bit concerned that he's running a playbook from an era that has gone by. And I'm just a little bit worried that some of the free cash flow is going to get spent in ways that I don't think are going to generate returns. But I don't know. These Netflix results I don't think that they were bad or anything like that, but I think things have got to change. And if I didn't at least see a crack in the Netflix, like the way that I see Netflix, I think that would be a lie, right? I don't think it's a major crack, but I think, maybe Peacock really can get people to pay attention to it. It's not a world I understand. I don't think that's actually going to happen, but maybe.
I think Brian, I own Comcast too. I think what's kind of scared people about Brian Roberts is that he's gotten the itch sometimes throughout his history of going after things that shareholders perceive as not shareholder friendly, right? I think he went after Disney and an activist in a hostile takeover that obviously wasn't successful. And around 2004, I think it was, more or less.
Yep.
And it was going to be an all-stock deal. And when it was leaked in a Wall Street Journal article, his stock went down a lot. And he wanted to stay in there, so presumably you would need to issue even more stock, right? That's fallen even more to bid a higher price. And he wanted to do that, right? And then you take a cable business that was showing signs of promise in the broadband business, and he bought an incredible asset cheaply in NBC Universal, but it did diversify him out of it. And you think if he might have been more focused in only cable, that maybe he could have consolidated further. And then I think the way he went after...
That was a good deal, though.
No, it was a great deal. It was an amazing deal. And the way he went after Sky in 21st Century, right? He created a bidding war with Disney. It did feel empire building-esque, but I think he makes the numbers work. and he's long term, right? And he's not going to be phased really about what the market thinks, which is also good if you trust him. And his track record doesn't lie. I mean, he's had an amazing. He's been in that business all his life, and I think he's been even in some ways an accelerant to the vision that his father started in starting Comcast. When I think in that he shares his story that in the 80s the LBO started buying kind of cable companies, and then he's like, what, we should do this, we just lever up and we got synergies. These leveraged buyout firms have nothing, right? They shouldn't get all the free money, and they kind of accelerated his ambitions to do M&A. But to your point, Bill, it's the game has changed a little bit, particularly on the NBCU side, and in terms of content going direct to consumer, and whether you really have the means to spend and acquire customers and keep customers and entertain everybody and then go global. It's, you kind of have to pick and choose a strategy, and you don't want to necessarily become, all of a sudden a very, very small fish in a huge ocean, right? With whales that are Netflix and others.
And Netflix shareholders don't care at all how much they spend. At all. Like, that's the thing that would make me really nervous going for, like, if I was competing. I get that, like, the buyback story has started him for you. But if Reed came out and he was like, look, we're pivoting, people would be like, Reed's God. We're okay with that. I really think so. Within reason, right?
I mean, in their defense, he probably earned a little bit of leash.
That's what I'm saying. Yeah. So, like, to compete against that guy is really, really difficult.
Well, yes, and he's also, like, he's gotten a lot of value out of that spend, right? So he's, to Alex's point, he's gotten that leash because he's executed. So I think Alex, you shared with me the AT&T investor presentation from I think a month ago or two, and then they shared basically the projections for HBO Max's revenue in 2025, and Netflix's content spend today dwarfs that number. HBO Max's revenue in 4 years is dwarfed by what Netflix is spending today. It's a tough game. It's a very, very tough game. And if you have that asset that's generating that cash and you're spending it and you're entertaining everybody, you have many shots and goals to keep people engaged, have a ginormous hit. You can have a bad quarter, a bad year, but it's hard to see how Netflix doesn't stay kind of dominant or a ginormous player, top two at least, in this streaming game, because it just takes so much to catch up to that. I mean, look what Disney had to do, right? They had to make a lot of acquisitions. They had to pivot the entire company. They had the best content assets in the world, and now they're catching up. But it's taken a huge shift in the company, and I think sprinkling some cash flow here and there is not going to get you to that level on Peacock's point with Comcast. So
no, definitely.
It would almost be interesting to see Brian Roberts say, like, actually, Peacock budget, we're going to multiply that by 4 or 5 over the next few years, and we're gonna be a huge player.
I think the thing that's so tough, and I mean, I know that, like, movie catalogs have play, and then you can put stuff on Netflix, like The Office when it went on Netflix, and maybe Peacock too. I haven't seen Office numbers, so maybe I'm wrong. I don't know, but like, I'm just thinking about, I'm going to personalize this with the podcast here. When the episodes drop, so let's look at episodes that were from January. All right. So my girl Jen Ross, only 18 people listened to her already this month. I guess that's only 3 days long, 6 people a day. Come on, people, listen to Jen Ross. Shomik's at like 11, right? Mike is at 14. For some reason, a lot of people are listening to Moses Kagan. Shout out to you, Moses. But you know what I'm saying? Like, the catalog, it does, I don't think it spoils. Like, I think that these episodes are pretty, I try to keep them relatively evergreen because I try to keep the conversation pretty high level and not, like, based on current events. But even, like, the past episodes, they just don't get that they for lack of a better term, they spoil quickly, even though I don't actually think they're like spoiling, but it's, Alex and I have talked about this. I need to figure out a way to highlight them, and I think I'm going to figure that out. I'm working on my branding, so I'm not advertising much right now because I don't want the coffee cup with my face, and then I switch up the brand. That doesn't make any sense. But the content can get lost in a sea of content, and it's how do you have that spend not just spoil? And I think you got to have, I don't know, maybe Peacock's much better than I give it credit for, but when I used it over Xfinity's cable box, it was absolute garbage. And this Xfinity app that I have is garbage, and I just don't understand it. I haven't seen HBO Max yet. I should probably try that product out because hard to have an informed opinion. But I got to be honest, man, Disney is dominating my life right now. I'm deep in the Star Wars game. I've been deep in Marvel. My kids will not shut up about Star Wars.
Tomorrow is Star Wars Day. May the 4th be with you.
Is that your favorite day in your house?
Well, at least my, I don't think anybody else's favorite day, but it's a fun day for me, I guess.
What would it take for you to sell Disney? What do you think they'd have to do?
I think in terms of the business performance, right? Outside of valuation, because obviously you can talk me into selling anything if it's high enough, right? I think in terms of business performance, I would have to think the TAM or the opportunity for them to get Disney Plus subscribers is not going to be 300, 400 plus over sort of a 5 to 6 year period, right? Basically a huge deceleration in terms of what even management is projecting, which is 240 million subscribers by fiscal year 2024 that ends in September. So that's not super far away, because I'm very confident, and also they kind of lose their way a little bit in terms of the branded content. So a combination, and that's also, they benefit that because hey, maybe if Marvel has a lull, Star Wars can pick up. Maybe they can get some hits out of 21st Century. Pixar hits a lull, Disney Animation can pick it up, and vice versa. So they're somewhat diversified in that sense. But I think you sell immediately, right? If you do not think 300, 400 million plus Disney Plus subscribers is something that is very realistic. Because the stock today is telling you that they're going to hit those numbers and that they're going to have pricing power, and that's going to generate a lot of cash. And I'm very, very confident that the parks are going to do pretty darn well. And I think the three of us have discussed this. And I was actually extremely worried about the parks in March of last year and even April. And I was worried about the liquidity of the company, frankly. But then as we kind of got to that June period, I think that, to your point, Alex, that we really recovered the market's losses. And I think there was a jobs report, if I think back in early June, that kind of people are oh, there's some reopening and there's jobs being created. And I think that's when the market kind of had a nice rise. And then over time, thinking about how reopening world, pent up demand, this is actually premium. They're not going to have to cut prices. It's going to be more expensive to go to Disney, especially by the time it's super normal to fly without masks or anything like that. So I'm very confident in that side of the business. And I think what Marvel Studios has done is amazing. I think Star Wars has had some hiccups, but they've really picked it up, especially with The Mandalorian and some new projects they have down the road. And Disney Animation and Pixar are doing extremely, extremely well. Pixar just won an Oscar for Best Animated Film. I think they almost always win. And the content that they put out in that Investor Day, I remember I called Bill that night. I think it was his anniversary or something, so he was out of touch, or girlfriend's birthday, something like that. And I called Bill and I was like, I think this is...
Be careful right now, Francisco.
Sorry,
you're saying a lot of stuff.
Edit it out. It was something important enough to miss the Disney Investor Day presentation live.
There you go.
So it was very important. But I remember seeing they were basically taking their entire company and like, look, the best content has to go to streaming. And yes, we will have, 5 to 10 movies that are of very, very high value that go to theaters. But everything, like, you work for Disney making content, like your best stuff, Disney Plus and Hulu. So if they can't get to those numbers of streaming that we talked about, then that's when you sell. And obviously that's not a perfect answer because you kind of have to see how things over time. And I told Alex the other day, it's inevitable that you'll have a quarter where the market thought they were going to add more subscribers than what they did, and the stock will sell off. It's happened a million times with Netflix throughout its history. So you're going to have to live through those bumps. So long.
I'll be curious to see if it's this quarter, based on what we've seen from some others. But
it could be. But they had their annual meeting. I think it was around February or even early March. I forget the exact date. And they kind of said that they were already at 100 million. So it's not that far off from the end of the quarter. So I would be kind of surprised if there's a shock, but it could very well be, or next quarter, right?
Yeah.
So it'll definitely happen. It's inevitable, in my opinion.
It's amazing how quickly like something like that will cause panic. But I get it. I mean, things are trading on terminal values and you got to get there. But that's when I think the long term, I don't know. It's hard to decide when that is signal and when it's noise. How do you guys think about that?
Alex and I have talked about it a lot, particularly with Spotify's earnings. Like, they basically missed monthly active users by not a huge amount, right? And they lowered guidance by not a huge amount. And the stock's off like 16% in a week. And I remember a few years back, Netflix said churn was higher because of credit cards expiring, and stock sold off enormously. So that obviously was noise, and Spotify's TBD, right? So it's really hard. I think, look, I mean, Bill, you famously bought Charter when they had...
I don't know about famously.
Well, yeah, I think it's a famous story in FinTech.
Dude, I'm still nervous that I didn't see something that everybody else saw because I was the idiot at the table.
Well, you bought Charter after they had a quarter, right? And we were talking about variability of results of Charter, but they had just bought they made an enormous acquisition, and integrating these cable systems is pretty complex. And they had a quarter where some subs dropped off and there were some integration issues. It was not super insane, but the cause of that, made numbers look a lot worse than expected, and the stock dropped. I don't know.
Yeah, that stock got hammered.
It was like 20% in a day or something like that. And that was obviously noise. I'm pretty sure that drop caused the stock to go below 300, maybe mid 200s, and the stock's at 670-ish today, in that range. So, and that wasn't that long ago. That was like maybe 3 years ago. So, yeah, there can be a lot of noise in it. That's when you got to be really confident about your knowledge of the business. And it's an art, right? I think businesses inevitably will go through periods of noise, but sometimes it's real and you got to get out. And it's a signal that something's wrong. So one has to be on top of it. I don't know.
So,
I don't have a perfect answer to that.
It's so funny to think about how, I'm thinking about the comment you made before, Bill, about, really buying kind of high quality, has a bright future. You're not going to, go to some of the value trap type stuff, or, the value stocks or whatever you'd like to call it. But it's so funny to frame, I think about Ben Graham with Geico, where it was such a massive contributor to his return, but in the mid 70s, they almost went bust. I think about Disney, which is, widely perceived, rightly so, as the best IP in the world. But 20 years ago, they were in a really tough spot. Oh, by the way, they kind of just lucked into ESPN. It was never really the focal point of the deal, and it ended up being a massively valuable asset. So I think about Microsoft, which I've obviously had a long history with, that went from the greatest thing in the world to a dinosaur to back to the greatest thing in the world. It's just, even for the best companies, it's funny how a period of a relatively short period in the grand scheme of things of, 10, 20 years, things can change a lot. So I don't really know what the answer is or what to do with that information. And the same goes for when you're betting on it becoming one of these types of companies. Like I would say we're probably doing with Spotify or even, with Disney.
The Twitter machine, bro.
What's that?
The Twitter machine. That's
or
what I'm
Twitter
betting on a little
or
bit.
Twitter. So I don't know. In some ways, I come back to an idea that you and I have discussed in the past where I think we both kind of concluded that someone like Buffett looks at a bet like Kraft Times, he places the bet, and then he doesn't look anymore. And I don't really know how to do too much better than that outside of the Spotify article I just posted today or whenever it was. I can't even remember now because I've written a lot of articles lately. But, you can pick your KPIs that you think are most important, and you can get an idea on, what's truly the TAM, how many potential customers are there here, what are they really going to be willing to pay for this, and what can profitability look like if those targets are hit. And you do the best you can to kind of track those things. And the other thing I'd say is when a company starts to fall short of those expectations, especially for an extended period of time, you better be able to find answers. And for example, in the case of Charter, you did find the answer. And there's a reason you got paid for it, because you bought into what seemed like uncertainty, but in reality probably wasn't. It was just fear that was, miscalculated, or however you want to put it. It's not always that clear. So when it's not that clear, I think the answer is you act a little bit more cautiously on position sizing, and you don't risk blowing yourself up on something that you're doing out of the sake of showing that you have conviction, or, making some stand that you don't really need to make.
I also think
what's funny? Sorry.
Oh, I was just going to say that I also think when there's a situation like that, like a company reports and there's potentially real problems, but it's a solid business underlyingly, or at least a strong brand or service. It comes down to a point you said earlier, Alex, and like a strong management team. Like there was the famous quarterly earnings that Disney had. They talked about ESPN kind of like losing subs, and that stock went down. And at least Bob Iger in his book basically said that that's when he kind of propelled him to have a solution, and that pushed him into direct-to-consumer streaming. And I think something, when you look at a Nadella, right, and you talked about how Microsoft, greatest thing in the world, dinosaur, now it's back to greatest thing in the world. Nadella Microsoft was a great asset, but when you put him there, he elevated probably initiatives that the company had that were vital for its future. He made Xbox more important. He made cloud more important. He put that capital to work in those areas. He brought executives that were very focused, thought like him as well. And it's not crazy changes, because it's not like Nadella is there with the Xbox team and, making them do stuff. It's just making decisions that you're empowering, you're putting the resources to work in the right place. Great CEOs, good CEOs can definitely actually take advantage of those situations where the market's like, well, the business isn't, hey, it's not doing as well. And maybe a Daniel Ek is seeing that maybe 2 years ago that growth was basically going to top off, and that's where it's like, hey, we got to push into podcasting. Then seeing Clubhouse emerge, now we got to push into live. And who knows whether those investments work out, but he's someone that's reacting extremely strategically, has a track record of executing extremely well, and that's all you got to ask for, really. So in terms of companies that great assets and great CEOs. So if you have someone there that probably think there's not a problem, and is more inclined to juice the numbers and lie, then, there's a lot of companies like that, and not necessarily frauds. You know what I mean?
Yeah.
And the results.
Well, another thing too, good CEOs, great managers, they recognize points when they need to make decisions. And I think of something, we talked about Comcast a lot, and we don't need to just hit Brian Roberts over the head over and over, but they've, as a point you've made to me many times, since the Disney Investor Day, when it should have been really clear what's happening here and what needed to be done, they've not done nearly enough. And I mean that in either direction. They could sell or they could invest aggressively. I contrast that with Rupert Murdoch, who saw where the puck was going and made a deal to partner and get equity in a company that he thought had a bright future, and that turned out to have been a massively smart bet, assuming they still own the equity. I have no idea, but point being that making decisions, even if they make you potentially look stupid or like you're giving up in a certain way, that can be incredibly valuable as well.
I doubt they sold the stock. I suspect Rupert doesn't like paying taxes and has figured out a good way not to do it. He may have some sort of a derivative transaction to get him out of some of the delta there, but
the source of all great investments, avoiding gains.
Yeah.
Well, dude, I don't know. There's something to be said for some of this.
There 100% is.
I don't know how much to be said, and I don't know how much of that is like late cycle. Something that I've been like thinking about is, you know, like I have talked to a couple more of sort of the growthy guys, and like I've heard the comment that, like, you know, one of the best investors that one of these guys knows, I don't want to say it because I don't know when the cadence of the pods are going to come out. I'm sure this will probably come out before that. But like, he was like, yeah, the best investor that I know doesn't even look at valuation. And there was a part of me that was like, that is like really offensive. Like, how can you even say that as an investor, that you don't care about a valuation? But I think that what that statement really means, if there's, and I this person must be good. I think that the fact is they're so focused on the stuff that we're talking about, like management and business quality and capital allocation within the entity, that like the valuation sort of takes care of itself, if that makes any sense. Now, I don't know how anybody plays that game. It's not a game that I can play, but it's kind of it's either a super late cycle comment or there's something really to it. And I suspect that it's probably half and half.
Well, there's a difference between valuation and multiples, right? Which
yes,
some people,
yes,
which in some ways is valuation, in some ways it's not. And thinking about how big a business can be if you execute and relative to the market cap today, etc.
Yes.
That's different than saying, well, like, I'm not thinking about the P/E ratio all day long, you know?
Yeah, or even current free cash flow.
Or free cash flow multiples or EBITDA multiples or whatever. That's not like driving my thought like every day or every month. So in that sense, I would agree with that answer. It's you know, if I'm thinking about Disney, I'm not constantly refreshing the multiples or things like that. I'm thinking about more like, well, this Netflix quarter, does that mean Disney is going to ground to a halt at a certain subscriber base? That's a lot sooner than I think so. You know, or you think about Microsoft, you're thinking about that huge cloud opportunity in gaming and other verticals and the deals that they're doing, that I think Alex has written about it in a Substack, which you should subscribe to.
This is true.
So that's how I would separate, like, am I thinking about valuation or am I thinking about these multiples and stuff that's really not super important in the short term? Because you got to think about valuation.
Following up on Francisco's comment about your Substack, because I want to get into this a little because I'm curious. I'm Substack curious. How much of what you're going to write about, and if you don't know, that's cool, but like, is sort of theoretical stuff like this versus just strict, these are the businesses that I like, or this is a business that I like? Have you like thought about what your product is in that way?
Yeah, I'm probably going to, you know, during periods like right now, mostly lean on quarterly updates and discussing what's already in the portfolio. And obviously, if there's any trading around all that, then I'll be discussing that as well. When it's non-earning seasons, I'll be doing a lot of new ideas and potentially stuff like that to the extent that I think it, you know, really adds to the conversation and helps people appreciate. For example, I wrote an article about Spotify today, and part of the conclusion was about position sizing. That's something that I might explore in more detail down the road to help, because if someone reads it and they go, well, I don't entirely know what that means. What are you thinking about? I'd like people to have clarity on exactly what it is. And it partly gets into this conversation here in terms of thinking about position sizing on a situation where there's so much of a bet on what's going to happen 10, 15, 20 years down the road that when the price moves 10% up or down, I don't know how relevant that really is. So just explaining some ideas like that I think will be helpful to people, or so they at least know how I'm thinking about it. And
position sizing is super under discussed, in my opinion. I don't have any good answers on it, but I think it's under discussed.
And not only like initial position sizing, but then how do you think about something that you bought 10% and it's now 15 or is now 20? Do you keep it constant at that percentage, or do you let it rip? Or there's so many ways you can like discuss and think about position sizing, because in theory, right, if you make a 10% investment and it's going to work out really, really well, you shouldn't be trimming as it goes up, at least in theory, right?
Mm-hmm.
If it goes against you and you're wrong, you should not be keeping it at 10%, which is something I think Alex alluded to earlier. If you get some huge drawdown in a stock price because of business results, maybe should be a little bit more hesitant to add.
I don't think I've had a single situation where, I'm trying to remember now, I don't think there's a single company I can think of where I bought the stock and it went down on a quarter that was objectively a bad quarter. And let's say I thought it was, it should be down 5%. It was down 20 or something. I can't think of a single situation where I bought into that and it actually worked out well long term. And that could just be this cycle, but I just think that's, and I've heard, similar sentiments from Nygren and other people that
Bill Miller said this.
Or Bill Miller, yeah.
Shout out to Bill. Thanks for listening. Come on the pod, dog.
You can't think of a single situation where
I personally.
Yeah, but where you bought after a big drawdown in a quarter and it didn't work out well?
A big drawdown that really was justified. I was like, okay, these results really aren't great. But hey, it's down 20%. I think it should only be down 5 or 10 because this is still a good business, and on and on and on. So I don't know. I think it's just funny to think about as you think about position sizing. Your natural inclination is to not let things get too big, and as things that you like get cheaper, typically because they're going down, you want to add to them. And the saving grace from all that for most people is that stuff in taxable accounts they can't sell because they don't want to pay gains. And it probably actually is a huge boon for most investors, probably myself included, if I'm being honest.
I think sometimes I think about ideal position size. Like, I think it's really hard to say, like, I've done all this work, boom, 10% tomorrow, right? Versus, like, I've done a lot of work, I really like it. There's maybe some stuff I gotta, like, check the box on that you really realize about a business after you follow it live and owning it for maybe, like, 6 months or more. And I like to think, like, well, I really, really like this asset. Maybe there's things I gotta kind of really understand if that market cap is justified. It would be 5%, but ideally it'd be 10. And then maybe you get those opportunities to kind of get to 10. It's really hard to say, like, bam, 0, I own none right now. Tomorrow is going to be 10.
Yeah, I agree with that. You guys like to make fun of me for limping into stuff, but this is part of the reason why.
But unless you really, like, for example, so I own, like, you guys know I own Charter. And then there was a situation last year where I followed Altice USA for a long time, and it was really easy for me to ramp. I didn't really have to ease into it. It's a business I know the industry really, really well. It's an company that I follow each quarter, and I follow the history about that company. And last year, it just, like many things, it was sold off, and it was easy for me to ramp, right? Because it's super in my circle of competence. But when it's something that's brand new, and it takes a long time to kind of understand the business, truly understand the business of it. 0% today, 10% tomorrow. That's hard, at least for me.
When did we all go to Streamsong?
November 2017.
Yeah. So the real Charter story for me is that I had bought a little bit right around there. When was that annual meeting where everything got hyphy?
Don't ruin the story for me. Okay.
No. It's not that ruined.
The story for me.
No, wait. When did everything get all?
You bought after that bad quarter. Do not ruin the story for me.
I'm not going to. But when were all those rumors coming out? When all the bids were going on?
Oh, I think that was around summer or late summer of 2017.
Yeah, it was right around, like, they had an annual. They had, like, their Liberty Day, right? And I had bought a little bit of Glibba slightly before that. But it was only like a 1% position or 1.5%. But like I was like, all right, I want to partner with Malone. I want to learn about these assets. And then that's why I was pretty ready when 2018. And then I put 8% more in that was a 10% position after that quarter. The one in June of 2018 is when I bought the shit out of it. That was, I think part of that was because I was following, and it wasn't as if I just like went 10% in off the bat, right? It was like, I like these assets. I like these managers. I need to follow it. And then I was mostly ready when that happened. But that said, like I've said, maybe I was the moron, but I do remember being like, I think it was Winfrey highlighted what happened as a key risk in like 2015 or 2016. When did the acquisition get announced? All those acquisitions.
The acquisition got announced. Well, it's a long saga, but the final acquisition got announced in 2015.
Yeah,
but Charter tried to buy Time Warner Cable a year before that. But
Comcast was involved and all that.
Comcast came in and tried to do the deal themselves, and that took like a year of regulatory review. It was rejected, and then Charter came in. That was another year of regulatory. But so, yeah.
And I'm pretty sure if you read the 2015 calls, like when the deal was under review or something, like Winfrey was like, "Look, this billing issue is like a real risk. Like it's a key risk. This might cause problems." And then when I was in 2018, when it manifested, I was just like, these guys said it. So I don't know. Maybe lucky, maybe good. I'm just glad I own it.
That's a great example, because those months made you like you're reading the filings, you're seeing the earnings reports, you're seeing how the management discussing. It gives you more time to study the history of the business, and then you got a huge situation where some kind of random integration thing cost a couple thousand subscribers. I forget the exact amount to kind of churn off. Stock drops 20%. And the business the value of the business definitely didn't go down 20%. And they're buying back a lot of stock. They're very confident what they're doing. It's a risk they had cited. They're probably super well prepared to fix it.
They had just had bids, right? Allegedly. Like, I know it couldn't get done, but like the assets had value. Yeah.
But imagine someone coming into that story that day. You're going with that skeptical view of like, actually, this might be a huge issue and it could persist, and, it'll take them time to ramp up about the business, the company, and where they came from. So it helps to get the kind of the knowledge. And that's why Buffett, being so smart and knowledgeable about business and business history, I think is what gives him the ability, tying this back to the annual meeting, to act very, very quickly.
Yeah.
You know what I think super interesting about the meeting, speaking of Buffett? They started talking about Geico and Progressive, and I'm trying to think back now. This has to have been, I want to say this was 5 years ago, when the idea of telematics at Progressive first came up, and Buffett kind of, we don't really think this helps with the underwriting decision. And it's so funny to think how it sounds like they've really just ramped up their efforts to try to do telematics in the last, I think Ajit Jain said last year. And he was also very frank about the fact that they have definitely missed an opportunity here, and they're underperforming relative to Progressive specifically because of that. It was just interesting to see the way he answered. It was also interesting to see Buffett, some would say cut him off. Others would probably say help him out, because I think he was shaking. He was a little nervous up there, which admittedly I would be pissing my pants if I was up there. So it's understandable. But it was just it was an interesting situation of him being really frank about something that I think admittedly, I wonder in some cases if Buffett is really close and has a lot of interest in certain businesses, that he maybe gets involved in decisions in a way that he probably should not be doing at this point. That might be reading into it too much, but
or gives a little too much deference, man. That is sort of potentially some of the cost of that model.
Mm-hmm.
Now, I think if that statement is true, he would argue that the benefits far exceed the costs, but it would be hard to own an asset like that, have it make you so much wealth over time and then be like, well, these guys over here are doing something, we should switch up. I think I'd give my managers the deference too. After 4 years, though, maybe I'd be like, all right, guys, we've done this long enough. The score is starting to be settled.
It was something they could test, too. It wasn't like a massive change in the business model. I don't know. It just seems kind of odd in hindsight how the whole... And it didn't really get discussed for a while, or at least not in a big way. It's just funny to see that it culminated in this after... It feels like it's been at least 5 years.
Yeah.
I think there's a lot of positives and negatives about the model. I think one of the things... Look, he talked about healthcare, how Buffett admitted that his companies weren't really super like on top of like getting efficiencies out of the healthcare system. I think Buffett thinks a lot about getting capital back from many of these businesses. Not all of them, right? Especially not like Berkshire Hathaway Energy. But you think there's potentially a lot of the businesses actually could have benefited from like pushing and investing more. Like I'm pretty sure Nebraska Furniture Mart could be way bigger. Like if they over time opened up more stores, right? You also have to be careful.
They got that
right?
one in Texas now, but yeah.
Well, yeah.
But yes, I agree with you.
So,
so you're saying they could have more than two?
Exactly.
Fair point,
I mean,
sir.
They could have had 50 of these, right? But
Yeah.
I think his approach of like, hey, maybe give me back the capital more could hurt some of that. And maybe Geico thinking more about like sending capital more to headquarters, maybe like, hey, we don't really need to invest in telematics. I'm not saying that's what happened necessarily, right? But you could imagine sometimes you're thinking about costs, being efficient, and you're not necessarily investing for like an enormous opportunity if you have a headquarters that wants to allocate capital.
Well, dude, they talked about the companies that have these myths that they tell themselves that become true. And maybe it's possible that the myth that Geico had was, we're so good at cost that we don't actually need to worry about, the investing in something that maybe like Progressive was taking a different strategic direction to get the ratio better. And maybe like the myth that Geico told themselves is we're so good at doing what we do that we don't need to worry about doing what they do. And maybe they just missed it a little bit. I don't know. But
yeah.
It doesn't seem like it's a moat that's bound to stick forever, right? Like Geico telematics seems like something that Geico could implement.
No, for sure.
No, it applies to the same idea at the railroad too. When people talk about the OR, it's some of it's transitory, and you can implement PSR as time goes on if you think it's the right thing to do. So yeah, it's more of a timing issue than anything else. It was just kind of interesting how it was all sort of framed and discussed about, especially for a business that's so visibly part of Berkshire.
Yeah, it definitely is. Dude, Alex, what's in the background there? That's a note from Buffett?
Yeah, I wrote him when I was in college saying I don't really know what I want to do, but you're an inspiration. Or I have no clue what I actually wrote, but I guess it was along those lines. And he wrote something back saying it was a very nice note and have a great day. So
did he tell you to join him next year at his annual meeting?
No, I don't think he cared. I was a broke college kid, so I couldn't spend any money downstairs. So he didn't care if I was there.
I think he likes that. I think he likes educating the kids. Did he tell you to start a Substack?
No, he did not. But this was in 2010, I think. So I'm not sure Substack was a thing yet. He's
a visionary, sir. He thinks forward.
I don't know if tech visionary is what I describe him as, but maybe.
That's fair. So tell me a little bit about how Substack works. The pitch is that it's a tech stack? Do you buy that it's tech enabled? Do you think that it works better than? I know that you said that review is not very good.
The pitch to me,
it obviously will get much better now that I've invested in Twitter, and that's bound to happen.
I should start by saying this, and some people told me they liked my comment on Andrew's pod about Review not having annual subscriptions. I've told Francisco this before. Somebody posted an article last week that I read, and it was a really good article, and it was on Review. It's one of the handful that I've seen, and I got to the end of the article, and they had the typical thumbs up, thumbs down thing, and I went to go click thumbs up, and they weren't actually buttons. It was just like a picture, so you couldn't click it. You couldn't click anything. So I don't know if that was just a one-time mistake, but yeah, whoever that was, I meant to thumbs up you, but it didn't let me.
How many newsletters do you guys know that are on Review?
None
that you guys know of.
I'm long Twitter, and if I started a newsletter right now, it'd be on Substack. So
that one I read was the only one I've ever read on review.
And Bill, you don't know any newsletters about review?
No.
I only know one that I subscribe to, and I don't know of any other, really.
Yeah, they got a long way to go. I personally think that with Substack's strategy of helping writers get up to help them fund their life for the first year, it makes Substack a very, very compelling proposition. And I don't really think that Twitter shareholders really want Twitter to go that same route. I mean, this is the benefit of focus.
Yeah.
And
from my perspective, I mean, Substack is just I toyed with other ideas, and I talked to Scuttle Blurb and a handful of other people, and I looked at basically trying to, build my own platform with tools that make it really easy. And even with all that stuff, it was just too complex for me, and saving 5 or 10 points on a take rate just wasn't worth it at the end of the day. And you look at something like Substack, you write an article in Word, you paste it in there, you got to fix 2 or 3 things, and you're good to post it. And it's super easy to set when it's going to go out. It's super easy to set who it's going to go to. The analytics are fine. Everything about it, from my perspective, it allows me to focus on what I want to be doing, which is researching companies, businesses, and then writing about them. So,
no, that makes a ton of sense. I would not spend my time dicking around with figuring out how to build out my own direct-to-consumer platform if it was built.
Well, the nice thing is, too, if you're, if Twitter wants to put some capital behind review, and if Facebook wants to get in this space, that 10% take rate from Substack might not last very long. So it might get competed down anyways. So we'll see what happens.
So I don't know if we've asked this or if we've discussed this. If we have, people can hear it twice. What exactly are you doing on the Substack machine?
Yeah, so I actually recorded a pod today, so I was thinking about this a lot. Well, first of all, I'm making everything I do completely transparent. And part of that was finding a way to differentiate the service. I thought about people like Scuttlewurb, who I just mentioned, Andrew Walker, our buddy Sleepwell Capital on Twitter. There's a bunch of people who are writing pretty compelling research. For me, I thought the way I could differentiate myself is taking that next step and full circle on everything I'm doing as an investor. So if I look at a new idea and I tell you about it, and it becomes part of the portfolio, I'm going to walk through every step of that. And obviously, sometimes it might be the next day, as it was with Spotify, or it might be something I look at and I don't buy for 6 months or a year, or, it could be anything. And then alongside, I'm going to obviously provide updates on stuff that's currently in the portfolio. And then anytime I make any sort of trade, I'm going to explain both sides of the transaction, what I'm buying, what I'm selling, and why, and talk about the sizing. And then finally, on a quarterly basis, I'm going to, just update, hey, here's what the position sizings are like. And I assume I'll throw in performance data at that point as well. So it's just being completely transparent about what I'm doing. And, I think there's certain people who will value that.
How did you think about pricing it? As someone who's running a quasi-content business with no idea how to price whatever the hell it is I'm offering, I just donated.
No, it's a difficult decision, especially when you look at the marketplace and you see a bunch of people who have Substacks that they charge $10 a month for. I talked with the two of you about it a lot, and I really thought about, one, what is the true addressable market here, and what do I need the numbers to look like for this to be a sustainable business for me, which is obviously in the interest of the people subscribing as well, because if I can do this full time, then it ensures that the quality of the work is as high as I can make it. So I thought about what in my head was a realistic TAM, or in terms of subscribers, 1-2 years down the road. And I also thought about, for someone who thinks like me in terms of their investment philosophy, they're essentially renting my brain, or they're paying a equities analyst to work for them. I'm obviously looking at what I want to look at, not what they tell me to look at, but still I'm giving them everything that I do as an equities analyst. I've been doing this for over a decade and have CFA, MBA, all that good stuff. So I presumably have some knowledge about what I'm doing. So I just kept thinking more and more, and I thought the fact that everybody else is charging 10 doesn't mean that's what I need to do. And if I do what I'm doing well, even at $350 a year, which is what I settled on, I think that's still a really compelling value. And then in terms of the monthly...
Wait, I'm just going to ask you a quick follow-up. You mean $350?
Yes, not $350
a year.
grand. Yes, $350 a year.
So I could have you as an equity analyst, and I would pay you a whopping $350 a year.
Yep, and you can
Do I
reach
have
out
to
to
pay?
me.
Do I have to pay your health insurance also? Like, is there some hidden fee here that I don't know about? Because that doesn't sound like a whole lot of money.
That's included in your fee. I'll figure out the health insurance on my own.
Okay. I'm just checking because I think a lot of these Substacks are way underpriced.
Yeah, I think that's definitely true. And, we'll see how it all evolves over time and whether or not people can have sustainable businesses at $10 or $20 a month. I think it eats into your ability to give the time and effort to it that you would ideally want to. So in some ways, it's probably better to subscribe to Substacks where the person's actually charging a price that enables them to have some sort of a living.
Yeah. I think something, if I would chime in and help in seeing the value of Alex's service from the outside, is that there's a lot of services that good investment ideas and great write-ups. You can probably make a lot of money out of them. I think this is selling really two things. Well, a couple of things. It's investment ideas, but it's really portfolio construction. How are you thinking about events in real time? Because someone can write a great investment thesis worth the money on Substack or whatever other service, but then that's it. They might not know, like, hey, I bought initially a 5% position, then like 2 months later it became a 10% position, or maybe I was wrong and then I sold. And it's really an Alex's service. You get that kind of live real time plus the portfolio. And I think at least for now, it's also easy to contact you, at least in Twitter DMs, unless they're being extremely blown up. So I think it's more than just, hey, I'm feeding you good content, which is good content, but it's really in your brain how you're thinking about everything in real time. Because if you do one trade, you send out a note, which is not necessarily a post, right? It's just a note to subscribers.
Yeah, I mean, especially now I have some cash, so it's not as full of a note as it would be if I was fully invested, which I will be soon enough. But yeah, it's every time I trade, I'm telling people, hey, before market opens, I'm doing this today. So obviously it's not investment advice, but I'm telling you what I'm doing. So, and it's also, this whole idea is also part of the reason why I priced it the way I did with the monthly at $50 a month. Obviously, relative to $350, it's significantly more expensive than the annual plan. And the reality of why I did that is because I'm looking for people who want to be along for the journey of the evolution of looking at these companies and industries and thinking about how to invest intelligently. I still want to have a monthly option for people who feel the need to trial because they might not be as familiar with my work as others. But I really want people who actually want to learn alongside me. So when I post something like Jason Kyler's thoughts on HBO Max and the future of media, for a lot of people, it's like, well, why the hell would I care about that? But if you understand what I own and the companies and industries I'm invested in, it plays perfectly into the things that I care about and that I'm thinking about long term. So,
because it's different in some media analysts talking about what Jason Kyler, not getting the pronunciation right.
We'll never know. We'll never know how to say it.
We'll never know, but it's someone with like a media analyst, reporter can write something good about Jason Kyler, but then you write what you think the things that are insightful from his interview, and then to what you said, you apply it. Well, like, I own Comcast, and this is how I think about that, and I own Disney, and how it changes your assumptions potentially or doesn't, which it adds another layer that I just don't think others would provide. I'm very bullish on your service. That's why I'm.
I have two things. One, I don't suggest doing things very often, but I will suggest signing up for Alex's service. Alex, where can people sign up for your service?
If you go to my Twitter page, you can find it on the, what's it called, pin tweet.
Which is what? What's your Twitter page, sir?
At TSOH_investing.
There you go. Who do you think your target market is? I feel like, as somebody in my position, your service is like a no-brainer. I think for most investors that are interested in learning the amount of content and writing that you've put out on Guru Focus, I also think your service is like easily a no-brainer. Do you think that, like, are you targeting institutions also? Or do you think that you're mostly going to go after the individual investor? Are you like, how are you thinking through that?
Yeah, but I've had a fair number of people that it seems like, or I presume that they either run a shop or they're an analyst at a shop. So I'm not catering to that in any sort of way, but that's been a common thing I've seen, at least so far. I'm also, as you said, people like yourselves or people who are, looking for idea flow or seeing how somebody else manages their portfolio. So probably individual investors who are, obviously figuring out how to save for their family or are managing a decent amount of money. So I think it's pretty broad. It's for anybody who's, I would think, active, long-term, high quality, potentially concentrated. If they don't have that approach to investing, if you're looking for something that has catalysts or someone who's going to be doing a fair amount of trading, I'm probably not the person for you. But if you're looking for high quality businesses like a Microsoft or a Disney or a Comcast, I've owned those names for 5+ years. So I'm looking for ideas like that I can own for a really long time that I think are going to generate outsized returns over the course of a full cycle.
And occasionally curate when you're ready to pick up dollars.
Occasionally curate. Yeah.
Right.
No, I'm open-minded to other ideas.
Have you sold that yet?
No, I still own a pretty good chunk.
Yeah, I do too. I'm not sure if I'm making a mistake on that. We'll see now. I don't know. Hopefully she's buying like a fiend. I love you, curate customers.
I mean, the commentary from management suggests that we should have had a permanent step up in what the base of business is, but we'll see whether or not those trends actually hold.
I think the hard decision in that entity is going to be Q2 or Q3. I have this version of reality in my head where these women have been inside for a long, long time, and they're just trying to get outside and away from the TV for a little while. And that could put a decision to us about whether or not like the habit has actually broken or not. And I think that's going to be a hard call to make.
Do we know who the new CEO is going to be yet?
I thought it was the lady from Disney that came over, but I'm not sure. I don't think it was. That's just what I think.
Oh, okay. Got it.
Because it seems like it makes sense. She came in, merchandising seems to have really improved. They had the Baby Yoda gift. I mean, don't you reward somebody like that with the CEO gig? Like, she brought Baby Yoda to
that
QVC.
Like a nice little layup, but she made the call and it paid off.
Yeah, I don't know. I just think I don't know who else you would. There may be somebody, but she's who I would if I were a betting man. I mean, I guess I have a bet down, but like if I was going to bet specifically on that, I would think she has the inside track. But maybe I'm wrong.
That seems like the logical choice versus if you have the more, nothing against NBA executives, but more of the corporate strategy person being a CEO versus a merchandising.
Yeah, you need a merchandiser,
expert.
I think, for sure.
Speaking of bets and Baby Yoda, Francisco and I had a bet. I don't know when this actually ends. We might be getting close on time. That I had told Francisco that Apple would take a run at buying Disney before X number of years, and if it happened, he had to buy me a life-size Baby Yoda, which, if I remember correctly, it probably cost like $5,000. I think I'm inflating it now, though. It's probably like $300, but it was expensive.
Yeah, it's. Do you have the link somewhere? I think it was like $300 or $400.
We'll have to find it. I'm running out of time, though. I'm running out of time.
It seems like that ship has really sailed.
They had a chance to do it too. Right after the investor day, they could have done it. But
they needed to tackle that before Disney Plus started to run.
Yeah. Well, and from a regulatory perspective too, Apple is going to be. I don't know if big deals are in their future.
You wouldn't think.
I think they can pull it off
with Disney.
They can pull it off. They wouldn't. I think they would need to spin off some assets, but I think they could. They could like spin off ESPN, ABC. But the real.
I'm not sure that's the real competitive concern, sir. Maybe. I mean, maybe.
No.
We could carve off the assets that all have terminal value risk. Don't worry about those. Francisco, as a Disney shareholder, is willing to give those up.
No, but what I meant is that I mean, the heart of it is the App Store and Disney Plus, in my view, right? Because the parks don't matter, theaters don't matter to Apple or regulatory. Like, Apple's not gonna make Disney's competitiveness. It's not gonna change it in the parks or the theaters or
that's fair.
Certain other aspects. So it's more about the App Store dynamics with content, particularly Disney Plus. But I think if you get rid of a lot of assets, you can't argue that one app, right, necessarily is going to harm others and consumers. But I'm not a lawyer, so
I haven't even looked at Apple TV since like it launched, and whatever that show with Jennifer Aniston or whatever was on, where she was like some news reporter or whatever.
Yeah, morning show or whatever.
Yeah, it was like reasonably good, but then nothing else.
I watched recently with my wife For All Mankind. It has 2 seasons. It just ended last week or 2 weeks ago. And it was a really good show. And it gets better as it goes through. And it's a show, I'm not going to spoil anything. The premise is that, like, basically the Soviets land on the moon before the Americans. And it's kind of like how it changes history. And actually, I can tie this to investing because it made me think a lot of, because what happens as a show is that because the U.S. actually had competition that was better than them, at least initially, in terms of the space race and the moon, it made the U.S. better. And technology advanced. And, you know, in the show, you get to like Apollo 20s and stuff, and they're still landing on the moon. And I think the U.S., you know, hasn't landed on the moon since like the 70s or so. This show kind of having competition really on top of you and strong competition raises your game. And it makes me think about business and businesses that kind of thrive in an environment of hyper competitiveness are real jewels, because we all want that like Google search bar business that prints cash and it's amazing. No one can touch them. But you know, businesses like classic Costco, right? You got to survive and crush a ruthless environment. I would argue Spotify, really just people on top of you all the time. And if you're extremely, in Walmart throughout its history, and if you're really, really successful in that hyper competitive environment, I think it shows something special about the business or management or both. And I don't know, kind of random thought about an Apple TV Plus show that probably not a lot of people have watched, but it's a good show, and it made me think about business.
Dude, it reminds me of the Mototac concept that I think it's Polling Capital has popularized, and I'm pretty sure Sanjay talked about it. I know Sean talked about it. That's a really interesting like concept. I was thinking as you were talking, the commonality that I see between Spotify and Twitter is I don't have, and this could be like overestimating Twitter's asset duration. I'll cop to that if I'm wrong on it, but I'm not very concerned about either of those assets' duration. I'm concerned about how much cash they can generate off of that asset.
Fair.
It's like it's a weird thing for somebody like, I mean, we've all sort of had to morph together, right? I mean, we've all talked through these things over a period of now 3.5 years together. And I don't know, it'll be interesting to see whether or not we're placing this sort of strategic shift in some of our assets is, I think it's the right thing to do.
But to be clear, only you own Twitter.
Yeah, no, I get it. I get it.
I'm joking.
No, you're not. I get it.
I'm not opposed.
Well, I think you have very legitimate concerns, and I'm not like, I don't know, dude. Part of me just likes that. I mean, I owe like everything to Twitter, and I know that this is not like a reasonable. This is why I don't fucking run a fund, folks. Like, I invest in some stuff that I want to own because I like to own it. That's not a sufficient reason to run something in outside capital, but for me, it is. I do need to be careful that I don't get over allocated to it, though. If that, I mean, I do honestly believe that they can do some real things, but I do not think that, like, I don't know. Actually, we'll see whether or not this ticket sales to spaces things works. The hard thing about all of, all right, let me take a step back because sometimes when I speak, I'm very vague. The hard thing about ticket sales to Spaces or exclusively hosting on any podcast platform is like fundamentally reach is really important. Now, maybe that reach can drive some like super unique space that I can organize, that I can charge, money for tickets and stuff like that. But the way that I'm trying to run this podcast and sort of whatever media little business I'm building is I'm really trying to like think through Bezos's be obsessed with your customer. But like I view my customer as the guests of the podcast. And I think that if I give the guests the best possible experience, then the listener will have the best experience. And I think that the guest experience is restricted if I put it behind a paywall. And I think it's like unfair to the guests. But I don't want to do that.
Just a comment on, you're talking about Twitter Spaces doing tickets for a live event. 2 thoughts on it. As it pertains to your business, it's completely logical, right? Because let's say you have a guest and you sell tickets, you make it interactive. It's an opportunity to ask questions, and then it's going to go for free on a podcast. But if you pay for it, you had an opportunity to actually ask questions to you live and to your potential guests. So there is a value to that can be adjacent to your free podcast business for the user that's going to be on every platform.
Yeah.
If I have my skeptical hat on in terms of Twitter, I think the tickets are an extremely logical thing to do. My skepticism is that, like, look, they're still scaling this. It appears that they're growing that well, and I think it's getting traction. But they just had an earnings where the stock went down, and they're leaking this to the press, and the product still needs work before it gets to a real scale. I think it's a lot of these have crashed. I think recently have been buggy. So I would just want to see them to just kind of crush it with Spaces, keep building it, keep growing, keep adding features, and then think about tickets. You have time, right?
Yeah.
If you get if usage is enormous, if usage keeps growing, then just pushing back the monetization of tickets a couple quarters is not going to be the end of the world.
Speaking of usage too, it looks like Clubhouse data was out today. I don't know if it's verified or anything, but April downloads were down about 90% from February. So
yeah, I think Sensor Tower data.
Whether or not that's something about the medium or share shift, I guess we'll have to wait and see. But I think it's still super early.
I think I agree.
Spaces, dog.
Maybe.
I don't think it's Spaces. I think you log in on Clubhouse.
Haters.
I think if you log in on Clubhouse, you see way more rooms than Twitter open. And a lot of the rooms on Clubhouse are trash, honestly. But
they are trash. I tried to find some stuff, and I was like, I saw Exhibit hosting a room, which I got love for hip-hop and stuff, but I'm not trying to listen to Exhibit have a discussion with people.
What was it about?
Yeah, it's
the weed.
Oh, nice.
I got in for like 2 seconds, and then I was like, this is so stupid.
I think one night I opened in, there was like 3 rooms talking about like Tinder strategies. I'm like, what? So
if you got to log into Clubhouse to talk about your Twitter strategy or your Tinder strategy.
Tinder.
Yeah. Your Tinder strategy, you probably are a candidate for the upgraded match profile need.
But
funny story, when I was doing work on Match, I won't say deep, but I got familiar with the r swipe right subreddit, and it's people who are literally just talking about like, here's the best thing to do. This new Tinder Gold thing is BS. It doesn't work at all. It's an interesting subreddit to go down sometime if you're bored.
I'm not going to do that.
Well, if you research Match, you should. But you won't because it's too expensive. You don't like growth stocks.
It's not true. I like growth stocks with potential, not that are realizing their potential.
Fair. Bumble.
I think I have some growthy shit. How dare you? I own Facebook and Google. Those are growth stocks. Next.
Nice. So are you going to do a Twitter Spaces with tickets, Bill?
I don't know. I'd like to. I don't really know. I don't know what the hell I'm doing. I think that...
Do you want to monetize?
Yeah. I mean, I'd prefer to, all else equal. I'd at least like to cover the cost. But again, like it just need to be the right guest and people that want to do it. I don't want to like force. I just want to do things that are right for the guests. And, like that's part of why, like, in certain weeks I have so many podcasts dropping. I don't want to hold back episodes because I'm worried about the cadence that stuff drops on. Like, I'd rather, if I record something, I want it to come out quickly because I think that that's the right thing to do for the guest. And if I overbook myself or down the road kind of have to say, like, hey, I got to take some time off, like, that's the consequence of the strategy. But I don't know. I don't know how to answer the question. I want to monetize. How should I monetize? You're my strategic advisor.
I think it depends. I think, obviously advertising is hard, but I think given the scale that you're growing to, it's going to be easy for you. I think we've debated subscriptions for you many times, but I think that the live events, Clubhouse, Spaces type of thing is a real opportunity for you. Because you can upload those later on and free people can listen to it. But live, paying for the ticket and being able to ask you or your guest a question, especially if you cater it towards a special type of guest, right? An investor that people want to be able to ask a question to or to you could add significant value, and it doesn't, people will pay up for that. And selling 100 tickets at $10, it's not a whole lot for an hour, not bad. And if it works out, I think you can slam dunk that in your first try, and for an hour is pretty good. And obviously, if as you keep growing and you keep testing formats, and eventually you can do one that gets thousands of people and it's priced a little bit more expensive, and bang.
Have we talked about my theory? I think
you really have an opportunity there.
Have we talked about doing the Netflix series of podcasts where I drop like 10 episodes in a week? And then
we've talked about it.
What do you think about that? What if somebody sponsored a series and it was like 10 episodes?
I think
they were thoughtfully pieced together.
The thing is that I don't think you wanted to. 10 could be you could debate this, but 10 could be a lot because you don't want to overwhelm.
It's 20 hours, dude. Maybe 30. What are people doing? Working? Get out of here. People don't work anymore.
It's going to drive a lot of attention, and the key is that those 10 be really damn good episodes.
Of course, it'd be good.
No, I'm not doubting.
Basically, be 10 of these.
But it's a great strategy. I think you're going to get a ton of attention. I think Barstool, I think I mentioned to you, does this one called The Corp. And it's by seasons, and they drop them staggered a couple at a time. And I don't know if they still do it. It was Alex Rodriguez with Big Cat.
Those are bigger names than Bill Brewster, to be fair. But for now.
But little by little, man. But I think that strategy, they get a lot of attention once the season launches. So I think that could be a good strategy for you.
I just think it'd be fun. I don't know. Kind of, like with Alex and the Substack thing, I just kind of want to do something that's different. And I think that, the every Thursday, just have a pod every Thursday is, fucking boring. I don't like that. On the other hand, I don't want to train people to expect 2 to 3 episodes a week from me because eventually I'm not going to be able to keep that up unless I actually get paid because these things are relatively expensive to get produced.
I think consistency, though, and obviously one a week is, it's a huge time commitment from your part, but people look forward to them. They like them. They engage with them. So, hey, you can take a couple weeks off or whatever. You can do the season drop and then get out of town for a while. But I think it's nice to, if you really enjoy the job that you do, to come back every week for another episode.
Yeah. No doubt.
I think that I don't know why. I think Wednesday might be the more efficient day to drop. The more I think
you've always hated my day.
You and I have debated this. Well, initially you dropped Fridays, and I told you it was the worst day to drop, but you didn't listen to me.
This is why you're my strategic advisor now. I've given you a promotion.
Thank you.
Though I have
shout out Andrew for dropping our pod Friday morning.
Dude, I'll tell you what, I like what he's doing. I think he's got a very cool niche. I like what he's doing. I like what Scuttle Blurb's doing. I like what you're doing, Alex. I think like FinTwit's got a pretty cool intersection of guys that I think are sharp and that also like to create stuff. I mean, obviously my homie Greenbacked, Jake. But like I don't know. I think there's like a very creative vibe in FinTwit, and it's cool.
Yeah, there's an authenticity to the way you do things, the way Andrew does things. Scuttleburb's the same way in terms of his writing, and there's a uniqueness in that is, it's just so different than even reading something that's, well researched, like a, initiation report from a bank or something. Like those are generally well done, but there's a way to talk about things that just hits differently for people who are doing this all the time, like we are, and like a bunch of other people are on FinTwit, or even doing it part-time if you just really love it. But there's a way to cross that is very difficult to do. And it's somewhat similar. Speaking of Barstool, it's similar to what they've done in kind of the sports space or in the pop culture space, in a way that someone like ESPN just doesn't really know how to respond to it. It's just a different way of reaching the audience that's just so much more authentic and so much more what they're looking for, is my sense.
Yeah, I think the interesting thing is going to be how much of, like what we were saying with Spotify, I wonder how many people will continue to, like what I could see a scenario of the world being is a lot of people have an Anchor sort of account or whatever to host, and a lot of people do like a podcast to drop. But in order to actually like have a professionally produced podcast, it's got to get big, or you got to have like enough money to just like fucking light on fire, which I am in the process of doing. But it's not that much, and I actually don't mind it that much. I've gained more than I've spent, but it's weird. I don't know. Long term, it's going to be difficult for people to survive, I think.
Yeah, that's why Spotify bought like Megaphone too, right? Because they wanna be able to get every single independent podcast via Anchor, or many of them, or most of them, and then also cater to the big networks that have a bunch of different shows and programming and hosts, and cater them that way as well. So it's going to be interesting, because I think the flood of content is just beginning, really. I mean, I think if you listen to podcasts, which I did, I probably listened to podcasts for, I don't know, 6-7 years, and the quality and the improvement, and sometimes shows go away, and sometimes new shows pop up. Last year, a bunch of shows have popped up, including yours, and I think that's not going to stop, and I think that's actually pretty exciting, but also a little bit overwhelming, right? Because there's so many hours in a day, so I got to start to shut down podcasts I used to listen to because there's new, better shows today. So I think there's
this goes to the Netflix thing that we were talking about, right? Like how quickly does the content spoil? That'll be interesting to watch. But I was bringing up earlier stuff about like how many people have listened over the past couple, like to the older episodes. On the other hand, they have seasoned a lot. Like, so those first ones dropped in November, and the total listening has almost like increased by a third, if not quite a bit more, on some of those episodes. Like Mike Mitchell is, people love Mike. Anyway, y'all didn't know about him before, so it's just kind of interesting to watch. I do think there's a tail to it. I know I'm talking out both sides of my mouth, but to be fair, I was quoting May numbers, and it's May 3rd right now to timestamp this, so it's not totally fair to make fun of it.
But you know what that tells me? Two things: the more people are discovering your podcast over time, which I think is a positive sign, or more people are discovering podcasts in general, and that brings more people in.
Yeah.
To be able to discover your pod. So I think it's a really strong sign. If it's increased by a third of listening, and it's been, 7 months or so, or 6 months.
Yeah.
It's
roughly.
pretty darn good.
I told Alex he and I have to whore ourselves out to macro and Bitcoin. That's how you get ratings. You start writing like anything macro, and then if you can tie in Bitcoin, it's just like crack to people.
Yeah.
Thin crack.
Yeah. I got an article about Comcast coming out first, but then I'll get to that Bitcoin article next. That's the next one.
A deep dive on the Robinhood S1 when it drops is going to get you
there you go.
A lot of clicks.
I'll do a deep dive on the PR ladies' comments about Buffett and Munger, what they said about Robinhood and whether or not it's true. We'll see how that holds up.
The PR ladies, what the PR ladies say?
What'd she say, Bill?
I don't know. Just some fucking stupid shit. I don't know. She said something about like the old guard is jealous of us or some nonsense. I don't know. She used to work for Obama. I bet if Obama knew that what she did right now, he'd be disappointed that he's even anywhere near her resume. I feel bad for her, to be honest. Like, that woman needs a paycheck, and she probably thinks that she found some cool company to work for, and she doesn't know that it's some sinister piece of shit. But, that is what it is. Maybe they can fix it, man. But I tell you what, when I watch that, my aunt and my uncle go up to do that interview with CBS or whatever, and the guy says, I have no trading experience. And they say, are you sure? And he says a little. And they say, oh, now you're approved for options. It's like, I mean, all right, a suicide wasn't enough. Like, we haven't, come on. When is enough?
It's
I'm
insane.
sure they'll get a nice valuation.
You think about Schwab, and I opened a Schwab account recently, and I asked for option approval, and you get a bunch of questions, and the option approvals sometimes there's a delay. It's not like automatic, and the fact that Robinhood just allows you, it's like, yep, boom, a little experience, bam, a bunch of options. That's just like, options are, deadly for somebody who has no experience, and honestly, people who have
They're deadly for
probably should
people
stay
that
away from
have
them, too.
experience. Yeah,
exactly. So it's, yeah,
and then the money is going to
Tough.
go to the venture capital people, and then they're going to say we're democratizing investing.
Yeah.
No, you're not.
Yeah.
But whatever.
I mean,
I'm very on the record about this.
yeah.
But I don't know. You guys want to talk about anything else? What do you want to do?
When are you selling Curate? You talk about it a lot, so I just want to know.
I don't know.
Serious, but not serious question. Actually, I'm curious.
Yeah, no, I have sold some around here, right? I mean, my cost basis is out of it. Let's see.
How do you view that? My cost basis is out of it. It kind of ties to the whole position sizing, and I think it's more of a mental thing.
Well,
like the
dude,
cost.
it was 19%. Okay,
at the peak,
and then
or
yeah,
at
the
cost?
peak. At the peak.
Okay.
At cost.
A cost. Okay.
Before the transition or before the transaction.
Oh, okay.
So then it was like post transaction, right? Because I got 45% back or whatever pretty quickly.
Return.
I don't know. It was like, yeah, that's right. And that was like, so then it was like 11-ish, maybe 12. And then it ran like crazy after I was panicking on the phone with you the day that it sold off. And I was like, oh shit, I might have been wrong here. And loud. That's not fun. And then it was like I had Curate at, 16, 17% of my book. And I always had, like, even when I talked to Andrew and pitched it, I said, like, I thought 7% was roughly, like, a number that I was comfortable with. So now it's that, 7.5. The sheet I'm looking at says 7.5. What is it? It's probably like, it's a $12 stock, $12.50. So that's like $5 billion-ish, 400 million outstanding, something like that.
Do they
shares.
report this Friday too?
Yeah, May 7th.
I love how this is the one position that you and I overlap on. We actually both have pretty good holdings here, and
it's a $5 billion company.
We almost never talk about it together. We talk like every single day. We almost never talk about Curate.
I just don't. I'm not gonna sell this quarter. I don't think I'd sell next quarter. Like, I think what's gonna happen this quarter is I think that the headline number is going to be pretty decent. They may run into some supply chain issues. I bet margins are under pressure a little bit because you got shipping costs and whatnot. Although that may be pushed down to the vendor. So I don't know, man. We'll see. I'm watching ordering frequency, and I expect some of the economics to deteriorate over time as they have to like invest more in buying the leads. If it's Q2 or Q3 when the ordering, like if these women don't order like they normally do, then I'm going to have a hard decision. And then I got a problem. But if they keep ordering, I'll keep holding.
Do they disclose kind of how the amount of orders that they get from people that are watching Curate outside of the bundle?
Yeah, they're beginning to give that kind of data. I don't know if it's like that specific, but they are giving you the way to triangulate what's going on. So we'll see. It's not as easy to own as Charter, I'll tell you that. And there was a lot of tax implications to pulling off that trade that I'm not sure I love that, but it's a nice problem to have.
Well, you can wait until it converts to long term and capital gains, and it won't be a big a deal, right?
Yeah, for now. But when it's mid-teen size of my book, I don't really want to wait until it's long term.
Yeah.
Like then you just make the economic decision.
That's fair. I think the body language that you got to watch out for is Maffei. That's the real tell. He'll always want to put a brave face, but at the same time, he always kind of nudges you in terms of how he's really thinking about the asset as an investor, which I think is one of the benefits of having him on board.
They didn't buy any shares. I that was a little bit surprising to me. If they give another dividend, I'll be over the moon happy. Because I'm not really that into the buyback. Yeah.
I always thought... Sorry, go ahead.
No, they may have bought shares and then issued a bunch as a bonus. I mean, they had a huge year last year, so I can understand rewarding your employees and that kind of an outcome. So I just kind of need to see what happened there.
I mean, I always thought that they would do the recap. So they gave you preferred stock, they gave you cash, and I just always thought they would delever significantly, and that would be a way of kind of
the equity could get a pop.
It could get a pop for sure if the multiple stays constant and you delever. But they didn't. Then the fact that they bought back some stock. Did they buy back some? They announced a buyback. Did they actually buy back?
I don't think they did, but we'll see. My sense is they did not.
The fact that they announced it at least kind of showed that they were willing to get frisky about it. So, that was a great investment. And I applaud you because you really put yourself out there.
Well, that could have been very stupid. That we may be resulting. I will say that they have about $1 billion in cash. So when I said it was a $5 billion company, let's call it 4.6 because I think they could probably do something with $400 million of that cash.
No, for sure.
I don't know. We'll see. Time will tell. It was fun. It was fun to bet against the market and be right. Now I'm just terrified that the market's right. I don't. It's not like screamingly cheap. You know what I mean? So.
What's your free cash flow kind of number on it that you?
I mean, I always said 500 to 750. That might be a little low, but
it's more conservative. I think that feels right based on when I did the work on it versus $1 billion plus.
Yeah, well, I mean, some smart people think higher than $1 billion, and you know what? If they're right, I'll be super happy. But like the way I think about it is, you're looking at an asset that has either somewhere between a 5 and 10 year duration here. That's kind of tough to have a view on at this stage. I don't know that that's a sell, but to me, it's not a buy.
How about you, Alex?
I mean, as long as Charter keeps adding those pay TV subs, we'll be good. Well, I guess they did this quarter, though, right?
No, they dropped a little bit this quarter.
Yeah, the problem is that pay TV is in a very bad spot.
They have good position on Roku, man. Home screen. They're calling you in.
Yeah, well, We'll see how these Roku Google negotiations go and what that means. But I don't know. We'll see how that game goes. Pay TV is in an incredibly bad spot given what everybody's saying, and I don't know what that's going to mean over time. But HBO Max is certainly going to do something with sports eventually. Comcast is, as far as I can tell, pulling back on sports in a pretty good way, which means those assets will go to presumably Warner or to Disney, I would think. I don't know. We'll see what happens. You could see a lot of content move off of linear here in the next handful of years. So I don't know how to handicap what that means.
The weird thing is that like the bundle offer, like the value of the content in it is just like eroding, but the strategy within it is to just push price and just like whoever will pay, will just let them pay. And it's like, that doesn't feel like it's going to last for too long.
I don't remember the last time I watched entertainment content that's not like live, like a news or sports.
MTV The Challenge, dog.
Like an FX show or like an HBO show on linear.
Right.
Yeah.
I don't remember the last time.
Does Disney Plus have Archer on FX?
It'd be on Hulu, right?
Hulu.
Yeah.
But
that's what I thought.
But in
Archer needs to come to Disney Plus in the adult section.
But in many international markets, it's on Disney Plus via Star. So the tile when you open in Disney Plus and you got Disney, Pixar, Marvel, Star Wars, National Geographic, you got another tile that says Star in many markets, and that's where you get all the adult content. That's where Archer is. So like,
remember when I thought that they were gonna fold some of that into Disney Plus, and that was completely wrong because then they ended up leaning into Hulu a little bit.
I think that's inevitable though. The problem is the Hulu ownership structure.
Yeah.
Which Comcast is a partner there. Which apparently they tried to go to Disney last year to buy out Disney, and Disney was like, no, thank you.
Yeah.
Because remember, Alex, that Comcast quarter where Brian Roberts, this was last year, I'm pretty sure, he's like, our direct-to-consumer streaming strategy, and it starts with Hulu. I'm like, what?
Yeah. The one they're getting ready to sell.
You're a minority shareholder with a put call provision.
Yeah, with a fucking collar around it.
Yeah.
Right?
That was clearly the time that they wanted to like buy Disney out, but obviously Disney wasn't going to sell that.
I mean, Comcast has scale, so they're fine.
Oh yeah, that's right. That's right.
As Brian Roberts likes to say, they have scale.
Okay, odds.
They do have
odds, that. For the record, odds. Comcast finds a way to merge NBCU Sky assets with Warner Media.
First of all, it's not going to happen. Second of all, you and I have been talking about this shit forever.
For a couple months, it's felt like forever because of the pandemic, but it hasn't been a year. Has it?
Okay, but I bet a realistic, like real guess is September, October last year.
Yeah, that's fair.
Yeah, that is fair. So to the Johnny come latelys to this idea, we were early on it.
I still think
and by we, I mean Francisco.
I still think it gets done.
Yeah?
It's
you got to do it quick,
thing.
Man.
I think they find a way to get it done.
That's the issue is timing, because you can have these deals that make a lot of sense, but it's right place, right time. It could wait. This is one of these that it really can't. Like the industrial quote unquote logic of it sort of falls by the wayside the longer you go out.
If they do that deal, I think all bets are off. Like, then I don't really know how to handicap anything. Except for I would swim to Disney given the choice, because I know they have brands that people will stick with, and they have a release cadence that I think will keep people. But like that would make me nervous for Netflix, to be honest.
Let's say
I think
Francisco,
that could substantially increase churn with that offering.
You feel okay owning Netflix if that happens?
It would be a huge competitive threat, I think, to Netflix. I think I would still feel okay with that team and the focus that they have in executing on. And I mean, those two companies have stopped in a significant way. They still license some to Netflix, a lot to Netflix, but they've stopped in a significant way and have tried to build out their own services. But the thing about these deals is the positive for Netflix is they announced that deal tomorrow. It's going to take almost a year to close, and a year after that to actually get the execution kind of showing in the results, and not like cash flow results, but like actual like
content
product.
and whatnot. Yeah.
And so that's why time is of the essence. You delayed this deal 3 years. It's really 4 years for closing and 5 years for execution, right? And 5 years from now, God knows where Netflix is at. Maybe they can build a lot of the assets that those guys have. So they announce it tomorrow. It's a different ball game. I think Netflix has to seriously think about owning IP in house, and I think that's hard for them as well, because obviously you can't. Companies that have really attractive have IP are in conglomerates, but it's a formidable company. I mean, you think about, they have the parks. They're going to have a big consumer products division. They're going to have a lot of IP. They're going to have global presence. Like HBO Max basically can't expand in Europe because of Sky. They can't even go to Canada, man, because they license a lot of assets out to one of the
Bell
Canadian
Media.
telco players. Yeah, Bell Media. So you do this deal, it accelerates global expansion, content assets, sports, tech, consumer products, box office, performance is concentrated fairly well. It makes so much sense, but I think it's more about the personal governance things, about Brian Roberts wanting to break up his company, meeting of the minds in terms of valuation, and Jason Kylar is there, and you got Stanky as the CEO of AT&T. Does he want to let go of that asset? So
He might, because that's kind of Randall's deal, right? So
sure, but also like if he sees huge opportunity, right? Wouldn't he want to be involved in that asset in some capacity?
dude, you could own equity in a beast, and
No, it's not about equity. It's not about equity. It's about management teams being
But
involved.
what I'm saying,
This
you
ain't
could
Buffett, right?
But what I'm saying is, you could spin this asset off. You could own some sort of interest. I don't know if it'd be minority or majority, whatever. Put your guys in charge, let them run a focused strategy, and then you actually focus on the AT&T business, which is wireless and building out, whatever your fiber strategy is. Like that, I could understand that as a CEO making that decision.
Yeah,
They're already kind of rid of DirecTV, at least from his perspective, right? That deal is no longer on his hands. You get a focused organization there.
Honestly, it's all about what gets him
Cut
paid
the dividend.
more. What gets him paid
that's
more.
right.
But
Yeah.
Jason, look, I mean, you got
I know he
Jason.
won't cut the dividend. That was a joke.
No, if he cuts the dip, in the early days, when I bought Charter, one of the things I thought was like, if AT&T cuts the dividend, that's a risk to Charter, because they're gonna have so much capital to invest and improve their wireline assets. But that's another story. But I mean, you got Brian Roberts, right? Can you imagine him spinning off those assets and then,
Yeah, that's who I think would be tough in the whole shebang.
That's really, really tough. Does Brian Roberts just want to run the broadband business? I don't know. It seems like
It
no.
doesn't seem like you would buy the Sky assets.
I think you need to include the Sky assets.
So then to shrink the company's focus a little bit like that. I mean, things change, right? So maybe,
Yeah.
but that would be tough.
Yeah. But if they wait, this is all to Netflix's benefit. I mean, Disney reacted like in 2017 is what they announced, that they were going to like start these plans going. And we're now in 2021, and you're really starting to see that they have real huge potential. Apply that to a framework of these mergers, right? Things take time.
Yeah.
No, definitely.
Except for Twitter's execution. Oh, snap. That's not true. That's a false statement.
That's going to be something really interesting to follow, honestly.
I know. Well, we'll all follow it together. Perhaps we'll do a follow-up space and charge ticket sales.
You buy more
On
of that?
that note,
Or no?
I bought a little bit more, yes, after the dip. That's not financial advice, folks. For now, we're going to shut this down, and us three will chat very soon. The rest of the listeners will hear from these guys again. I hope you all enjoyed. Thank you guys for joining, and we'll talk soon, yeah?
Awesome. Thanks for
Yeah,
having me.
thank you.
Sign up for Tiso's stuff, for real. And by Tiso, I mean Alex.
Reach out if you want to talk.
All right, have a good one, guys.